Hello, everybody, and looks like we're kicking off another hour of Fool24. For the members who have already been on, welcome, and also a new welcome to anyone who's now joining us on YouTube Live. As you can see at the Chiron at the bottom, there is a disclosure that we always want to remember for everyone that this is for educational purposes only, and please do not misconstrue any of this as personalized advice. Danny and I are here to give our thoughts, our expertise, and kind of share our personal views, but we do want to avoid from giving out anyone any personal recommendations. If you have questions and you're joining us from YouTube TV or YouTube Live, please go to sli.do and enter the code FOOL24 if you want to get your questions in. We always remember we have moderators on board as well checking questions, so let's all keep it civil with everybody involved. My name's Tyler. I'm a nomadic fool, as the Chiron may indicate, coming to you live from Tbilisi, the Republic of Georgia. And joining me for this hour is Danny. Danny, how are you doing today?
I'm doing great, Tyler, and I always enjoy being on the show with you because between you and your broad knowledge in areas other than tech and my fairly broad knowledge in tech gives our viewers a good, a fair amount of questions to ask and covers a wide area.
Yeah, good coverage, but the Venn diagram of expertise doesn't intersect too much. So typically, when one answers a question, the other one is like, "Yep, that sounds about right to me." So,
Works for
um,
me.
so as we get started here, Danny, whether if there was anything that you wanted to start with, there was like maybe a news piece or something like that that you saw early, or if you just saw some questions that have been kind of sitting in the queue that you're like really chomping at the bit to get to here.
Well, one thing that I wanted to talk about a little bit here is, a stock that is a perennial favorite with some of our viewers, and that is Palantir. And Palantir Technology stock has taken it on the chin over the past couple of days. Um, so there's a couple of things that have happened. First of all, let's start off with the fact that Palantir was extraordinarily had an extraordinarily high valuation. So as such, subject to a fair degree of volatility, let us say. So there have been two stories that came out over the past couple of days that have really impacted Palantir. Now, the first was word that CEO Alex Karp had changed his pre-existing trading plan. This is a 10b5-1 plan that he had filed with the SEC, and he basically threw out the old one and put in a new one, and revealed that he plans to sell 9,975,000 shares of stock between now and September. Now, that would have, before the stock started falling yesterday, this would have amounted to about $1.24 billion in stock. Now, it's important to put that in context. A lot of Alex Karp's compensation is tied up in stock-based compensation. He gets a lot of his compensation in the form of stock options. So it isn't particularly surprising after the stock has run the way it has that he would be looking to sell some shares, particularly at this time of year because tax season is here. He's probably got a lot of taxes to pay on those stock options with the stock, running up about 800% over the past 3 years. So I wasn't particularly surprised by that. Now, the second factor weighing on the stock is the fact that the Trump administration announced plans to slash U.S. military and defense spending by about 8%. The Defense Secretary Pete Hegseth told senior Pentagon officials that they needed to draw up plans to cut their budgets by 8%, and they needed to do so here in pretty short order.
Hey,
Now,
Danny, can I interject? Can I
sure,
interject here? Because
sure.
you missed something there. It was 8% each year for the next 5 years. So that's actually
8%.
closer to a 40% cut over the next 5 years.
Okay. Um, Now, and you're right, I did miss that. Um, so investors took that to mean that Palantir Technologies was going to have a much smaller opportunity um, because it made its name by selling advanced software systems, data mining, and artificial intelligence to defense departments and intelligence agencies before it expanded into data mining and AI. Now, investors, you know, they see that the Defense Department is slashing their budget, and some of these fair weather investors headed straight for the exits and said, "Yeah, this is not going to end well." Now, not everybody takes the same view. Dan Ives of Wedbush sent out a note to clients this morning that said Palantir's unique software approach will enable the company to gain more IT budget dollars at the Pentagon, not less, despite the initial knee jerk reaction from the street. He went on to say that Palantir was well positioned to benefit from Washington's more disciplined spending approach. So, over the past couple of days, the stock's down more than 20%. Yeah, given its valuation, I'm not all that surprised. In fact, I had been forecasting that Palantir would see somewhere in the neighborhood of a 50% drop somewhere over the next couple of years. This is much sooner and much less than what I said, but not surprising.
Oh, it's only been one day, but yeah, I mean, when it comes to government spending these days, there's a lot of questions involved. I mean, 40% haircut at the Department of Defense is a considerable cut. So if indeed real, that's a lot. Um, I was going to do a little bit on retail REITs, but it sounded like the hour before us on shareholder yield, our colleagues Matt Argesinger and Anthony Scavone, they covered that pretty well. So I am going to go instead of going on my open on Tanger factory outlets, which is less interesting than Palantir. I'm going to jump right into the questions here because I see that I need input was kind of gave us a gentle reminder that we missed a few questions yesterday. So I'm gonna try to address a couple of those from yesterday. Two of them that he had from our hour yesterday. The first one was take a chance to look at Kelly Parter Group. It's an Australian trade company. Um, I have not looked at that one yet, so I can try to do some digging maybe on one of my I do a 2 hour show on the weekends. Maybe you can join me then, and we can do a little dig either live or when I have a little bit more time to dig. And then the second question was, what do you think of Lanthius Holdings? The ticker is LNTH. This is a diagnostic specialist in the mostly we'll call it biotech, but it's not really like a therapeutic. It's for used with medical imaging. So if you're getting an echocardiogram or you're getting a scan under a PET scan, which is proton emission tomography scans, at your nuclear medicine facility at a hospital. These are the radioactive tracers that they use to enhance the images, and basically Lantheus has developed a couple of what we could call blockbuster diagnostic tools. One of which, like I said, for echocardiograms, and the other one for detecting prostate cancer that had metastasized in other parts of the body for people who weren't in remission. So it's been those two drugs have been a blockbuster for them. Earnings has been considerable over the last couple of years because of it. So the question is, when would you know if they are still rowing in the right way, and what is your prediction for their compounded annual growth rate over 5 years? So rowing in the right way. We'll start with their current existing stuff or existing platform of diagnostics, and I would say in that regard they're rowing in the right way. I mean, they're patent protected. They for it, Polarify, which is the radio diagnostic for prostate cancer. That one is patent protected, and they just got approval from the Centers of Medicare and Medicaid Services, such that the diagnostic agents for a PET scan can be billed separately from the scan itself, which is a nice revenue boost for them. And the adoption rates for this particular diagnostic tool have been very high because detection is just that much better for it. when it comes to their pipeline, there's some interesting things. Some are being fast tracked because of the critical nature of them. They have some tools that are looking some radioisotopes used for perhaps doing early detection diagnosis of Alzheimer's. Is one of their big ones. Some other solid tumor cancers, because prostate cancer tends to be a solid tumor cancer, so they're looking at some other diagnostic tools that could be a better detection agent for those things. So these are all, you know, phase 2 clinical trials. I think maybe some of them are being fast tracked to phase 3 based on their results, but there are some interesting things in the pipeline, as well as some radiotherapeutics where they take the diagnostic agent that is good at targeting the cells, pairing it with a therapeutic like a cancer drug or something like that to actually turn it into a cancer treatment, not just diagnostic. So there's interesting things. The thing that makes me a little bit nervous, and I've said this a couple times when talking about Lanthius recently, is that they have been very aggressive at making acquisitions ever since they got this, Pylarify prostate cancer diagnostic on the books. They had all this free cash flow, and a management decided they wanted to buy everybody under the sun related to this industry because you're trying to build out the pipeline, maybe trying to find the next blockbuster. I've been a little bit nervous seeing the rate at which they've been making acquisitions, because it has been at such a torrent pace. This is a business that I think last time I checked is maybe in the $4.5 to $5 billion range. Last time I checked for market cap, and in January alone, they made what could amount to $1.5 billion worth of acquisitions. There are, of course, earnouts on those, meaning like the diagnostic agents and the companies that they acquired have to meet certain milestones in terms of getting through phase 3 trials to earn out the entire acquisition price. But if they're all done, that completed, that's a $1.5 billion acquisition. That's a lot of money going out the door for a company of this size. And so I'm getting a little apprehensive of them piling on all of this extra work in the development pipeline, because I think it's only like 30% of drugs that pass a phase 2 clinical trial actually even go into actually become commercial use and actually go to like what you would call blockbuster status. And so, it's nice to have irons in the fire, but if you blow all your money on these and you have nothing to show for it, it kind of, ruins the shareholder returns that we thought we'd be getting from this blockbuster drug. So my prediction over the 5 years, I think their existing portfolio of things that is generating revenue today is going to do incredibly well. My only question is how much is management's going to spend it on other things, hoping to replicate their success. And so that's the biggest question I have over the next 5 years.
So I fished back through yesterday and found a question that was left by I Need Input that I did not get to. Hey, Danny, in your opinion, what are some small cap companies that could be huge winners, like MercadoLibre, ticker MELI, or Netflix, NFLX, in the next decade? If indeed I was had a crystal ball and would be able to forecast stuff like that, geez, I would be independently wealthy. So, a lot of times I don't necessarily look at a stock and say, okay, is this a small cap? Could it grow like a Netflix? I'm kind of more, the way that I look at things is that I will look at a company and say, does this company have a very good opportunity ahead of it? Do I like the things that management is doing? Is there, a large addressable market? Does the company have something that is unique that it brings to the table that will give it the opportunity to thrive? From that perspective, there are a few companies that I'm keeping an eye on right now. We've talked about Palantir at length, and I think that this is a company that I believe could grow tenfold in the years to come, but it's not something that's going to happen right away. In fact, I think it'll probably be at least a decade or perhaps more. There are a couple of smaller companies, not necessarily small caps, I think one is, and the other one I'm not sure about. The first one I'll talk about is Dutch Brothers. Dutch Brothers is a regional coffee chain that is expanding in the United States. They have taken a little bit of a different approach than Starbucks in that they focus on what they view as fun. They have fun drinks. The people at the locations are, theoretically upbeat. They really focus on their employees and having happy employees and on having happy customers. They've got a secret drink menu. So you can go in and say, hey, I want to order this. And actually, if you want to know the secret, just, Google it because you can find it on the internet. Secret drink menu. So this is a company that has not been around for very long. Their IPO has been in the last couple of years. And right now, let's see, Dutch Brothers has a market cap of about $12 billion. So could they get to $120 billion? Sure they could. That's not too terribly bad. If we use Starbucks just for comparison's sake, not to say that it will get there, but Starbucks has a market cap of 128 billion, which is a little more than 10 times that. So the potential is there. Now, do I think they're going to grow as big as Starbucks? Probably not. But do I think they have a great road ahead of them? I do. Finally, the last one I'll talk about is a stock called Portillos, ticker PTLO. And Portillos is a regional fast casual restaurant chain. They focus on Italian beef sandwiches and Chicago style hot dogs, homemade milkshakes, and their homemade chocolate cake are all, big sellers there. I like what management has done in that they're positioning them as a family-friendly alternative to some of the other chains. When we went through the economic downturn here in the last few years, Portillos decided that they were not going to raise prices like all the other restaurants were doing. They said, we're going to do this so that families can continue to come here. That generated a lot of goodwill with customers. So it hit their financials pretty hard. So, they took a hit for a short time, but with all the goodwill and with all the recurring business that they have, I think in the long term, that will be worth it. Now, Portillos is, again, a very small company. They are currently, let's see here, Portillos has a market cap of 922 million. So they are indeed a small cap. And they are expanding. I like the management. I like the focus. They are working to get some technology. They're testing out some voice activated technology in the drive-throughs. I see a bright future here. Will they grow like a MercadoLibre or a Netflix? Now, I don't know the answer to that, but I think they could do well. And again, that's Portillos, and the ticker is PTLO.
I
Tyler.
feel like most of the ones I want to talk about here are like thinly traded companies on foreign exchanges. So I'll stay away from this for a minute. But speaking of foreign listed stuff, Richard O asks, can you recommend your best international and emerging market ETFs? I will speak about one, and I don't want to say I'm not recommending it, but this is, I would say, the one that I have been most interested in the most, in part because I've been very interested in investing in the Mexican economy. I think like 4 of the 5 last investments I've made have related to investments in Mexico. So the name of the ETF, let me just make sure I get it right. The ticker is EWW, which, probably one of the worst names for a ticker, right? Like who wants to buy something called EW? It is the iShares Mexico ETF. Trades, on the ticker EWW. The reason I have been particularly fond of this ETF. I know it's not all international exposure. It's not all emerging market. It's kind of a specific play on this in a certain way. But the reason I've been very mindful about going into the Mexican economy, and I think there's a lot of growth potential there in the next several years. We've seen per capita income growing there at a very fast rate relative to the rest of the world. They have a lot of structural advantages these days that could make them a manufacturing growth engine for quite some time. They have free trade agreements with 100 other countries. They have the relatively similar energy costs that the United States has. So a major competitive advantage to the rest of the world for a manufacturing base with low energy costs, and at the same time have an all-in labor cost, which is like pensions, insurance, all of those things. Their all-in labor costs are rather comparable to what we're seeing in China today. You're seeing lots and lots of companies talking about moving some manufacturing and things like that into Mexico through kind of like that reshoring initiative that we saw coming out of the pandemic, basically trying to make our supply chains a little bit tighter, a little bit easier to manage, a little bit less complex. Simplifying the supply chain, and nearshoring is a little bit of a euphemism for being less reliant on China for a myriad of political, pandemic related reasons, just kind of seeing it as a diversification strategy there. And I think the Mexico economy is going to do fantastic. Like I said, I've been investing in consumer goods there. I've been investing in industrial real estate. I invest in the Mexican airports. I think it's a great opportunity. And if somebody is looking for a similar opportunity, maybe writ large across the entire Mexican economy, you can look at the iShares Mexico ETF.
So we've had a couple of questions and comments related to Palantir. And Jimbo notes, if it's really a decade, 10x is exceptional, but who knows? A 50% drop from here will happen over how long a time do you think? In a day? He follows that up with 50% in a day, over a few months, over several quarters, over years. Seer, what is your prediction? I don't think
Good luck with that.
that far.
Good luck with that.
Right? What I'm not necessarily saying that the stock will drop 50% in a day, or if it's in a week or over months. I think my point here is that the stock is egregiously overvalued right now. And part of the dynamic for a stock that is that overvalued, even one that has a great opportunity, is that it's going to be volatile. And I think that's what investors are seeing now with Palantir. The stock's up 800% over 3 years, and then it takes a 20% haircut over 2 days. I'm not surprised. I'm happy to see that. Not necessarily that the stock is down, but that it's not going to continue to defy gravity forever. Because at some point, when the stock goes down, it's likely that I will add to my position. Now, I'm not going to do that now because the stock was still selling. When I looked this morning, I think it was still selling for something in the neighborhood of 178 times next year's expected earnings. So still egregious. Don't get me wrong. Now I am a happy Palantir shareholder. I like what the company is doing, and I think that this is a case where if you're going to be invested in this stock, understand it's going to be volatile. People are going to overreact. All the fair weather investors are going to get shaken out at some point, which leads to the next comment here. Myra in WI says, Danny, Lou said it a few hours ago. You can never justify Palantir's valuation based on defense spending. So how now can someone freak out over defense spending? And I think Lou was exactly right. This is a case where, again, volatility, high valuation, and the biggest opportunity, in my view, has to do with the company's AIP, or its artificial intelligence platform. Palantir uh, has data mining and artificial intelligence capabilities that it can use to integrate into enterprise businesses' siloed systems, puts all of the data together in the same place, analyzes it, gives you access to it on a single dashboard, and lets management make data-driven decisions. I think that will be a massive opportunity over the next decade or so. So I think you're right. It's never just been about the defense opportunity. It's certainly about the AIP opportunity. That said, like Tyler brought up earlier, if it is indeed 8% per year over the next 5 years, and we end up down, with a defense budget that's cut by 40%, I'm not sure that's going to happen. But in the event that it did happen, perhaps this does leave a smaller opportunity for Palantir. On the other hand, if they have the best mousetrap, they're probably going to pick up a better amount of that spending. So, it remains to be seen.
So Jimbo had a little follow up on my discussion of ew, the Mexico ETF ticker. He says, Tyler, Mexico is geographically as challenging for land transport, and you have regionalism, political situations, cartels, etc. Also challenging. I am aware. I don't deny that those things exist. But international. There's a lot of places in emerging markets and international markets where there are similar either political challenges or regulations or poor land trust. Just I worked for the French National Rail Agency for a couple of years, and we worked on a project trying to actually integrate European freight rail across all the countries. You have no idea how much of a boondoggle that is. My goodness, trying to build freight rail corridors in Europe was a challenge. So it exists everywhere. There are unique things to every country, but I don't think it's necessarily anything that's going to keep me away from some of the other things that I'm seeing. Manufacturing growth, like I said, GDP per capita, GDP's growth is going quite well. And I think there are some structural advantages that is going to make more business leaders and more, especially manufacturers, look here. Simple manufacturing has been a thing, but one of the things that you see over time is the kind of like the buildup of complexity. Your labor skill gets better. There's this wonderful podcast on the Odd Lots a couple of years ago. I can't remember who the guest was, but they talk about this idea of like, economic complexity and how you can become more complex over time by, taking certain ideas and they called it like basically like monkeys swinging through the trees, because like on one tree you have your industrial manufacturing base for maybe less complex assemblies, and then you add in one extra layer, and then all of a sudden that monkey can swing from one tree to the other because the forest becomes more dense, and before you know it, your capabilities have grown exponentially. A great example of that has been like the vertical integration of the textile industry in Bangladesh. So things like this I think, are going to happen in Mexico. It's the march of progress moves on, and despite those things, I there isn't enough signal for me that I would want to go away from my thoughts on that. And I'll hit while I'm here. At the same time, Ed asked about 30 minutes ago, for an average investor, what percent of your portfolio is in dividend paying stocks? Like, again, to the generic investor, I don't want to like say like what any person should do, because all of us are in very different parts of our lives. It depends very much on like how close you are to retirement. How much are you looking to actually use your portfolio as a supplement to your income? How maybe you're much earlier in your investing journey, and reinvesting dividends is a more important thing, or growth or something like that. Maybe you have brokerage and retirements and things like that. So it really does depend, and I don't want to make any personalized advice because I don't know what your portfolio or your situation looks like. But just to give an example of what I do, as somebody who is probably a little heavier on the dividend side than probably Danny, I'm maybe just a bold choice there. But so I have two portfolio accounts. I have a retirement account, a tax-free advantage account, and then I have a taxable brokerage account. If I have investments that I want to make with larger, higher yield dividends, I tend to put those into my retirement tax-free accounts because of the gains there. Can either be tax deferred in an IRA, or tax-free basically if they're in a Roth IRA. So when I do have dividend opportunities, I try to get them in there. Some of my dividend stocks are owned in my brokerage. It doesn't stop me from doing it. I will use like my brokerage for investing in partnerships where I cannot invest in retirement accounts, like oil and gas master limited partnerships, for example. And then the rest of that, and then I'll also put a lot of my non-dividend paying stocks into my brokerage as well. So I think I can't give specific advice, but it is a good thing, I think, for everybody to sit down and kind of strategically think about how you want to deploy your capital, depending on the type of accounts that you have and where you are in your life, for how much income you may need at any given moment.
Now, I wanted to tag on for just a minute there, Tyler. You might actually be surprised to know how much of my portfolio is in dividend stocks. However, I only started out picking, I picked several dividend stocks. Disney is one, Hasbro is another, Starbucks is another. Stocks that I bought, early on in my investing career. Disney, did I say Disney? Oh, and Canadian National Railway is another. And these were dividend stocks that I picked, more than a decade ago, and I have kept in my portfolio because I rarely sell. But surprisingly, the vast majority of my dividend payers are now stocks that have begun paying dividends well after I bought them. And if you go back, Apple is one of the big ones. Apple has been paying a dividend since 2012 now and pays a fairly reasonable dividend. It's actually up, I think, about 160% since they started paying a dividend. I have a couple of other stocks, Meta Platforms and Google, Alphabet, tickers GOOGL and META, that only started paying dividends here over the past year or so. So I think even for somebody like me who invests primarily in technology stocks, if you invest in a company that has a large market opportunity, consumer facing business, a lot of cash flow, eventually, the possibility exists that these companies will pay a dividend because they will need to do something with all that extra cash. And even with the spending that big tech has been doing on artificial intelligence, they still have more money than they know what to do with. And an increasing amount of that is going to dividend payments. There was a question.
Can't judge a book by its cover, considering all the tech stuff you talk about. I would have thought you would have been a little less dividend.
Actually, it's in my case, it has grown to about 25% of my portfolio, and not because that's what I chose. It's the way things happened. So BG asked 20 some odd minutes ago, Axon, ticker AXON, is back to November 2024 level. Is there more to drop? So for those who may not be familiar, Axon is the company behind the well-known taser, non-lethal weapon that police use to subdue unruly suspects. And the stock has done remarkably well in recent years. However, over the past few days, there's been some uncertainty that has happened. And Wall Street, as we know, really dislikes uncertainty. Now, what has happened is Axon has been in a relationship with a company called Flock. and Flock had a digital license plate reader technology that it integrated with Axon's systems. And for reasons that are not entirely clear yet, Axon and Flock parted ways recently, and there have been some highly charged comments made back and forth between Axon's CEO and Flock's CEO, and it's taken a turn for the ugly. One of the potential outcomes of this is that Axon and Flock will now be competitors rather than collaborators. And as a result of that uncertainty, an analyst came out, he lowered his rating on the stock, and basically said, these competitive pressures are creating uncertainty, and the fallout is creating issues. There's been a lot of headlines about this. Now, over the past few days, Axon stock has fallen a bit. I'm going to take a quick look here to see where it is now. It's actually down 11% today. And over the past 5 days, it looked like it's dropped from a little over $700 to about $527. So that's a fairly substantial drop. Now, does this mean that Axon is going to have less business? Not necessarily. I think there's a lot that we don't know. Axon is due to report here sometime in the next few days. Let's see. It looks like after
25th.
the market close on the 25th, they're due to report. And I think we'll get more clarity from management in the earnings call as to what happened, why this, fairly acrimonious split, and what it means for the future. Until then, expect the stock to be volatile. Wall Street doesn't like uncertainty, and that's what we're seeing play out with Axon right now. I will also mention that the stock this was another stock that had a really high valuation. And whenever you have uncertainty and a high valuation, what you get is a fairly substantial haircut.
Yeah, I was going to make a kind of a generic comment about high valuations being this is table stakes for just about any highly valued company. It's not surprising to see a company like that move 5, 10, even 15% in any given day, sometimes on even no news at all. So kind of this is what you're signing up for when you're making investments for companies like this, and it just involves you having the foresight and the gastroenterological fortitude to stay away from it, or to stay the course, I guess, if you will. And this kind of actually parlays into another question from Jimbo has a question. I'm actually, before I do get into that, for those of you who have just joined us, perhaps on YouTube TV or YouTube Live, excuse me, you can get your questions in at sli.do. And the code for that is Fool24. So invite you to please ask questions there, and we will do our best to answer them. Like I said, this is a tech and income kind of themed hour. It seems to be skewing a little bit heavy on the tech side because there's a lot of questions about defense-related things these days. And Jimbo had a question related to the ticker CLBT, which is Cellebrite. This is a company that has basically an expert in cracking mobile phones to extract data for critical investigations, FBI manhunts. Basically, if there is critical information that a law enforcement agency in the United States or Europe needs to get into a phone, Cellebrite is their first phone call, because this is an Israeli company that developed I think it was actually developed by the Israeli military and then became a public company, and they have some of the best data extraction capabilities and kind of cracking open encrypted devices. So the question he had, it's been sinking since its earnings report, which came out, I think, last week, maybe a few days or maybe 2 weeks ago. I don't know, all the days tend to blend together when you have a 2-year-old and a 4-year-old at home. And the question is, what do you make of its report? Was it affected further by the DoD cuts? As far as the DoD cuts, I don't know. Maybe, like I said, when you're these is highly valued companies, just a whiff of bad news can send stocks tanking at any given moment. I mean, it's down 4% today alone. But it was kind of a confluence of things. Like when I originally looked at the earnings report, it was kind of like in a vacuum. I was like, yeah, this is fine. This is more or less on track. Earning revenue growth year over year grew 23%. Uh, uh, Costs seem to not be scaling too much because sales general administration costs are up. R&D expenses seem to be going up as well. I mean, this is pretty par for the course for the business. There was a large paper loss related to revaluing some warrants and some stock grants and some stock options that was very considerable for the year. Hopefully, I think if I remember correctly on the balance sheet, they were some of those warrants have been priced out now, and so that's no longer a liability on the balance sheet. It's all been converted to equity. There's still some remaining, but not considerably less than what we had. So all in all, like I thought the earnings report standalone was okay. Um, at the time, this was a company that I I can't even look up its PE multiple anymore because it doesn't have GAAP earnings. But at the time of at the end of 2024, so like December 31st, this was a company that was valued at 74 times on an enterprise value to earnings before interest and taxes. So not quite PE, but before your interest and taxes, and for a company that doesn't pay a lot in terms of interest and doesn't have a lot of debt, that's pretty close to a PE ratio of 75. I think it might have been even a little bit higher. This is a very expensive stock, and it's like you said, it's almost priced for perfection. When you get anything that's like a little bit less than what Wall Street was expecting in any given moment, you're going to see these big swings. They had a sudden departure of its CEO a couple months ago. They have a new one in place now, but things like this are going to make people jittery and justifying very, very high valuations for companies that aren't, to be cliche, aren't firing on all cylinders or something like that. This is just like you said, this is table stakes. This is what you're kind of signing up for. You're investing with the idea that 5 to 10 years from now, this is all just going to be water under the bridge, and you just kind of have to have the stomach to deal with it.
So I've got a question from Chris L, who asks, if you had one or two stocks that were oversized, more than 40% of your overall portfolio, how would you go about diversifying or keeping the winner for the long run? I'm going to preface this by reminding that we don't give personalized investing advice. However, I can give you a anecdote from my own history. And there was a time several years back where Netflix actually accounted for 25% of my entire holdings. And that happened because over a period of several years, the company seemed it could do no wrong, and the stock kept going up. It was one of my earliest purchases. I had held it for, I think at that time, it was probably coming in on a decade. And I kept adding to my portfolio and building my portfolio around it. Now, there were some folks at the time who believed that I was just stone crazy for having one stock, particularly Netflix, represent 25% of my net worth. But I was comfortable enough with the company, with management, with the business trajectory, with the growth opportunity, and having followed the stock for a long time, I was okay with the amount that it was. And actually, if I look at my portfolio right now, my top 3 stocks represent about 35% of my portfolio. My top 4 or 5, it brings it up to about 45. So I don't have any problems with having a heavy concentration myself in my portfolio from just a few stocks, but that's primarily because these are all stocks I've covered for a long time. I'm comfortable with them. And even if one of these stocks was to fall by 20% or 30%, it's not going to hurt my overall portfolio that much. As an example, last week when the trade desk, ticker TTD, fell by 33%. At the time, that was my fifth largest holding. And now it's down to my seventh largest holding. But at the end of that day, my entire portfolio was down about 1/2 of 1%. And that's because of diversification within the other stocks in my portfolio. So for me personally, I don't mind having heavy concentration because I add to my portfolio every month. I kind of build around my winners and continue adding to companies that I believe have a good outlook, a good runway ahead. And that's how I do it. But again, no personalized investing advice here. How about you, Tyler?
Um, you know, I've never been in the fortunate enough position that I've had one stock go up to 40% of my net worth. The
Or even
largest
two?
publicly, huh?
Or even two?
No, no, I've been
No?
pretty diversified for quite a while. My largest position is actually in private equity, and I think at any given, I think at most it's maybe like 7 to 8% of my total portfolio. So, I guess I'm pretty spread out. I've never had, I guess, one of those winners run quite that well. And even if I think what ended up happening is like I made really, really early investments, and I've had stuff do incredibly well, but the amount that I've been contributing has been going up over time. And like when I made that original contribution, it was like a huge part of my portfolio. But because I've been contributing now for 10, 15 years, and spreading it around, going to other places, what would look like I think today my best performing stock of all time in my portfolio on a percentage basis is NXP Semiconductors. They're a
Hmm.
automotive semiconductor company, kind of not exactly the most advanced in sort of chips, a lot of near field communication stuff like that. I think on a like on a percentage basis, on a total return, because it has been paying a dividend, it's like an 1100% gain in my portfolio. But you know when I originally made it, it was of such a small thing now that I think even with all of that gain, it's less than 1% of my total portfolio. So, kind of a part of like adding to my portfolio over time and diversifying it. It just kind of is. It's still there. I still like it, and I plan to hold it. I just it's just been sitting there at a very, very small amount. Um, Matt, about 38 minutes ago, because we're going to go for a totally different direction here. He was asking about Vulcan Materials. I believe that I answered a question about this earlier in the week. Vulcan Materials is a company that does basically construction aggregates. So aggregate, sand, concrete, as well as some other building materials related things, but mostly known as a rock pit, which doesn't sound like a whole lot of fun or interesting, but I love rock pits. I think they're a great investment over a very long time, geographic advantages and all that. So the question is how much? What's the most you'd ever be willing to pay for Vulcan Materials? And so the reason that I ask is because it's traded for about 37 times earnings today, which I think in any environment is a pretty high multiple. This is a business that it's very steady, but it has some cyclicality. Over the past 10 years, revenue growth has been at best 14% and at worst has declined like 4 or 5%. So there's always a bit of, variability in what they do. They've been able to wring out costs to make, despite the variability in revenue, they've been able to more or less grow its bottom line considerably well. So cheers to them in that regard, and also using ever so slight little bit of buybacks, barely enough to really we want to call it that, but just enough to kind of to make the earnings per share look a little bit nicer. Um, for a business like this, decent growth, pretty steady in a very durable business that I struggle seeing existing, not existing 100 years from now. Um, anything, less than 25 times earnings, I think is a very reasonable thing. And, if I can get it for less than 20, even better. And I think a lot of today, when we look at the market and we say, and somebody says less than 20 times earnings, they're like, oh my goodness, that sounds so cheap, right? Well, I just want to, eh, we sometimes have a short memory when it comes to investing. I can remember when my early days here of Motley full time as a writer, as and doing what I do here. Apple was trading for 12 times earnings, and this was in like 2012, 2013. This was the idea of like, oh, all the magic in Apple is gone. Like, the iPod was dying, kind of had maxed out with its market penetration. How much are you really going to get out of the laptop business and things like that? And there was concepts that the iPhone was kind of a joke, right? Like, oh, it does. How is this not going to? How is this going to beat a BlackBerry? BlackBerry's got the whole keyboard right there on it, and you got to use this. You do it all on the screen. This is the silliest thing people ever. I know it. Like people are probably rolling their eyes, hearing me say this, but this was the market discussion during that time. There was the same time with the transition to Tim Cook. Like, oh, the magic's gone. Tim Cook is just he's a warm body to put in the seat after Steve Jobs. There's no way that this business can do what it does, do what it did under Steve Jobs, under Tim Cook. And you look at the company today. As hard as it is to believe at any given moment when you see valuations where they are today, like, oh my God, we will never get back to a time of, less than 20. It's going to happen someday. The markets work in cyclical ways. Animal spirits can compound a lot of things. And as I know it sounds bearish to say that, but it's just kind of the natural cycle of investing. And for me, I, I am willing to wait. I've got a long time until I'm done investing. I've got, if I've got probably 20, 25 years. If I'm lucky, less, because I've done well enough that I can, ride off into the sunset with my portfolio. But, if I've got 25 years to go, that means, I can wait 5, 10 years to make an investment. It's not going to kill me.
I I agree. I can't think of how many times over the years, we have seen good, solid companies. Apple is one, Amazon is another one, Nvidia is another one, where there were opportunities to get into these stocks at relatively cheap multiples. Now, when I say relatively, keep in mind that none of these stocks has ever been dirt cheap. But if you look at their valuations compared to, say, their 3 or 5 or 10-year averages, there have been times where their multiples have been downright reasonable, comparatively speaking. And when this, I remember in what year was that? I invested in Amazon after the stock cratered, I want to say 40%, back in 2015. And it's been a very successful investment. For me, Amazon up until that point was the one that got away. So, if you have a good company, solid business, strong management, and a growing opportunity, don't let the market noise keep you out of a quality company or scare you out of a quality company. I've
I'll
got
hit
a
this one really. Yeah, I
Sure,
just
go
want to
ahead.
hit this one really quick because it's a quick follow up, and we only got a couple minutes left. But Jimbo asked, tell us a little bit about private equity because I mentioned something about my investment in private equity. I should be clear. This isn't like I went to a private equity fund and invested that way. I was invited to invest in some seed rounds and some friends and family rounds for some startup companies. So I didn't actually get involved with private equity as like a company. So I don't have a whole lot of comments when it comes to private equity specifically. Or Blackstone is a company I wish I knew better. I read I read the quarterly earnings probably about once a year, and I gotta say I get really confused as I read it. Maybe if you're like I said, I if we're around this weekend, I'll try to do a little bit of a deeper dive on Blackstone's earnings reports and a little bit into the business, and maybe I can give a slightly more intelligent answer then.
So we've got a question from Vihan. Danny, if you look at the Costco chart, it hardly got a proper haircut over the last 5 years. Your thoughts? 4 years, around $400, now at a premium. So you made me look. So I'm going to pull up a chart here, and I would like to share my screen just so our viewers can see what I'm seeing. Now, I don't necessarily know what your definition is of a proper haircut, Vihan, but I see here on 3 different occasions where the stock was down more than 25%, and at least one occasion where the stock was down more than 30%. So, for me, I kind of would view that as a proper haircut. And I think that gave investors the opportunity to get the stock at a discount there in 2022. It has not had a proper haircut since then, I would say. But, and that's the thing. If you're a long-term shareholder, you will get these opportunities over and over and over again. The issue for many investors is that investing in a stock when it's down by 25% or 30% or 40% is mentally difficult to do. Because for me, in the early days of my investing, I started second guessing myself. I would say, I'm going to buy that stock when it falls. And then it would fall and I go, oh, but what if I was wrong? What if it's not coming back from this? What if I'm spending good money after bad? And that's where spending a lot of time understanding these companies, following the companies, knowing what they're doing, and that can give you the confidence to be able to make that move and take that step out in faith when you see a stock that's down 25 or 30 or 40%. And if you can do that, and if you're right, and those are the variables, you can do very well off something like that.
So, Danny, we have hit the top of the hour. That one flew by. Lots of questions about Palantir and defense-related companies. And with the next hour coming up, we have Brian Arelli and Lou Whiteman with a theme of pills and pulleys. I know Lou has thoughts on Palantir and defense companies writ large, so I'm sure there's plenty of things in the queue for you, Lou. And we are going to pass it off to you guys and enjoy the next hour.
Thank you,
Thanks,
Tyler.
guys.
Thank you, Danny.
Cool on, guys.
See you guys later.
I'm Lou Whiteman. I'm the pulley side of this, the industrials person. Happy to talk whatever you want. Brian over there is the pills guy, biotech, and also unsolicited medical advice, right, Brian? I have something I want you to
just remember it's a PhD, not an MD. So
well, but good enough. But yeah, we are here to take your questions. As the scroll on the bottom says, this is for educational purposes only. I'm giving you my opinion. Brian will give you his. We are not telling what you should do. We're not speaking for the fool. And hey, we could be wrong, but we are going to give you our honest opinions. Please get the questions in. Brian, I cheated. I was on a couple hours ago, and so apparently I didn't do a good job of clearing out my queue. So there are some. So if you want to, if you have something you have teed off, sure. But if not, I can try and get through some of this and give you time to get caught up.
yeah, I'll go ahead and start off with BridgeBio that reported earnings this morning. They got their first drug approved in November, late November of last year. It's a drug that treats TTR amyloidosis of the heart. It competes with Pfizer's drug that's a multi-billion-dollar drug. So definitely didn't have a full quarter worth of sales, basically a month worth. But they reported patient prescriptions as of February 17th of this year. So they went beyond the end of the quarter, and they said they have 1,028 patients currently have prescriptions for the drug Attruby, and then that's from 516 unique prescribers. It's always nice when they give the prescriber numbers, because that tells you, are doctors just trying it out on one patient, or are they trying it out on multiple patients? And and it seems that there was about twice as many prescriptions as there are prescribers. So there's certainly some prescribers that are giving it to multiple patients, and that's a good sign. So don't have much in the way of sales, but it looks like a strong launch so far. BridgeBio was up like 10% at like 9 in the morning East Coast time, but now it's basically come all the way back down and is flat for the day. So, but I think it's pretty good news for BridgeBio.
Good deal. Good deal. Tim reminds me that earlier today I said that I would try and give some thoughts on defense stocks, with Doge apparently turning its attention towards the Pentagon. I think someone else also said, Richard O said, sounds like I need to go shopping in the defense sector. I'm looking at you, Lockheed Martin. So let's talk about that real quick. Just some basic thoughts. For one, we don't know exactly what they're going to do. So all of this is speculative at best. I don't think anyone who's been predicting the moves of Washington the last month or so, and no prediction looks 100%. So all of this grain of salt. But Doge is looking to cut the defense budget by 8% annually over the next 5 years. Now, the bad math, I've heard it said all day, that's not a 40% cost cut. 8% annually for 5 years is like a 27% cut, because remember, we're resetting. But you're talking about an $850 billion baseline going to like 624. So it is substantial. A few things to think about as investors here. First, procurement is about 20% of the defense budget. The vast majority of the defense budget is payroll. It's salaries for all of our soldiers and all of that. So there's a lot of ways to cut. There's a lot of different things to do. But to say just, 27% in 5 years, to apply that to defense contractors, it could be more, it could be less. Secondly, we've also heard the vice president and the president various times say the U.S. needs to spend more on defense. And so we don't really know what Doge is thinking right now. President Trump has called for NATO to increase their spending to 5% of GDP. U.S. GDP is about 27.7 trillion. 5%, if we hit that threshold, would be 1.3 trillion. That would almost double the current Pentagon's budget. So again, I'm not predicting that either, but there are competing signals other than just this edict to get things down. I'd also note that stockpiles need to be replenished. Even if we don't invest in new technologies, we've used about 1/3 of our weapon stockpile in the last 5 years on various, mostly not having to do with us. But there are a lot of competing forces that make me feel as though seeing these stocks down 20-30% since election day is probably an overreaction. I don't think it's as straight and narrow that way. I will say, though, because Richard, you mentioned Lockheed Martin. These stocks were overvalued last year. And these stocks basically trade in a range. So they have what they have fallen is more back to normal levels. I don't really consider most of this sector to be on sale, especially given the uncertainty. But just remember, if you're looking at this, Brian's world is sort of one where you invest now to see what happens in 5 years. But with defense contractors, it takes almost a decade to build a carrier. So you are not, even if things were to change overnight tomorrow, just in what is billed and booked, you're not really going to see the earnings statements change for at least quarters, if not years. Don't over panic about what's going on. There's probably going to be something. There's probably going to be an impact. But those who are selling now based on these headlines are almost certainly, in my mind, getting it wrong or overreacting. So I think, we could talk about Fools if you have questions about individual companies. It does vary for company, and there are some nuance, but don't want to get too into the weeds. But take a breath and relax. Palantir is a special case because Palantir was arguably overreacts to everything up and down. So of course, on days when there's bad news, I think it's going to be the one that swings wilder because it is the highly volatile valuation stock. All right. What else you got, Brian?
Let's see. I had a sort of a general one that we can both maybe answer.
Mm-hmm.
But I just lost it as I was scanning down.
Okay.
Oh, so there was a couple of questions on Wingstop.
Mhm.
Toby did a rant on it yesterday. So if you look at the hour that Toby and I were on yesterday and search the transcript, you can see at least Toby's opinion on Wingstop.
So I'll hit a couple real quick. I think the dividend guys kind of talked about DEA, but Swing for the Fences 88 said, Lou, do you think DEA's portfolio will withstand the current government shakeup with slimming down employees and costs? Built for purpose properties a big risk. Yeah, so DEA Easterly Properties, they are the ticker is because they started by basically leasing to the Drug Enforcement Agency, but they do in general, they are a real estate investment trust that's focused on government buildings. So you get the risk here. They have been a great yield, pushing past 10% for a long time on this risk. I think it's a little lower there. To answer your question literally, will it withstand what's going on? Yes. I don't think the company is in trouble or at risk. The question, though, and it's a good question, is that will it impact their ability to pay the dividend at its current rate? That's a lot harder to know, and that's sort of the battleground in the stock. I tend to think it will, but I don't think it's a slam dunk. So I believe as far as REITs go, I think at its current yield, it is probably somewhat risky in terms of keeping that dividend. But for a long-term investor, I do think there's a lot of promise here. I actually think that if the government follows through on a lot of its outsourcing and selling things off, a natural place to do it would be to move to leased space versus owning and operating a lot of buildings. I doubt it goes that far, but I do think that if anything, there might be opportunity there along with the risk. But the disconnect with the stock, the valuation discount, is basically on that question of what becomes of that dividend if things fall through.
So Richard O 2 hours ago asked, what company or ETF are you looking to add to your portfolio with new cash? So I deployed my cash for February last week, and I bought Moderna. Ticker is mRNA. This is, of course, the mRNA company that developed one of the two mRNA vaccines. They're still selling about $2 billion. They're expecting to sell about $2 billion of their mRNA vaccine, their COVID vaccine, and then they also have a second vaccine that's been approved. So if you've at a market cap of about $13 billion, that means it's trading at like 6.5 times the middle of their guidance. So that seems pretty reasonable to me, considering how much of a pipeline, large pipeline they have, and how much cash they still have on their books. I was sort of a bear on Moderna all the way up and most of the way down, and I feel like it's finally gotten cheap enough that it seems like it's a good buy at this level, and it's down about 7% today, I think, on it looks like well, actually, I don't know. Yeah, it looks like maybe it was a analyst rating that has it dropping.
Does the sideshow drama worry you about this? I think, was it the state of Montana or something is going to ban mRNA vaccines, or they're talking about it? I mean, is this just noise until it's not, kind of like what I was saying? Or how do you even factor stuff like that in?
Yeah, I mean, I don't know. I don't even know if they can, right? Because it's not like, it's,
and it's not California where California is such a huge market. Like if they change emission standards on a vehicle, the rest of the nation has to follow because they sell so much. And so I don't know if Montana has that sort of market power even, right?
Right, exactly.
Yeah.
I mean, I think they're probably, it's probably a low number of sales anyway. Especially in given the population of the state, and then given the makeup of the population, not necessarily, being that interested in getting a vaccine for a disease where it's not, life-threatening at this point. So, I think that's probably a, low likely. I think anybody who in that state that really wanted it was probably going to just travel someplace else to get it, right? So it's not like it's not like they're banning their people from getting it. So, I think it's probably, I don't think it's a major issue.
I need input. About 2 hours ago, I asked, hey, Lou, what did you think of the latest Andava earnings? DAVA is the ticker here. And I think last week I said, yeah, that was one of the ones I was really watching this week. Andava is a tech consulting company based out of the UK, but operating internationally. They specialize in trying to keep the dinosaurs from going extinct, especially in the financial services industry, helping incumbents to modernize their technology. They took a real hit, like lost about 50% of their value this time last year when they had a bad earnings report and terrible guidance. And it's kind of been a story on the mend. And I said last week, hopefully with each data point, with each 3 months, we're going to learn a little bit more how much of that was just the macro environment and companies just fearful of signing new contracts, not knowing, when we were talking about hard landings, and how much of it was company specific. And I got to say, I need input. I wasn't overwhelmed with the answer we got. I don't think that we learned all that much. I think the question is still out there. One thing to really appreciate, they are an international company, but I've seen this with another company I talk about a lot, GXO Logistics. The UK economy has really, really struggled. It really makes what's going on in the US look really good. And to some extent, I think Andava is still fighting through some of that sluggishness. It is hard to get customers to commit to multi-million-dollar modernization campaigns when they're worried about revenue growth. And I think we're still seeing that. The quarter wasn't bad. There wasn't another panic. I think that the stock has been down a bit since it, but I still think that the jury is still out. I'm still hopeful as an investor that this is something they can grow through. I think there's a lot of opportunity there, but they did not close the door to the worries. And I think that's reflected in the stock. And I think that's fair, if I'm honest.
So
What
Vihan,
else? Yeah.
Vihan, when I was on yesterday, asked about current thoughts on Compass Pathways valuation and its future. The company, the ticker is CMPS. That's a $414 million market cap as I'm reading this right now. This is a company that they're developing a psilocybin drug for depression. So this is the active ingredient in magic mushrooms, and so they're they sort of give you a trip and then they do therapy during the trip with you, and then you eventually come down, and then it seems to at least in the phase 2 improve symptoms. So they're running 2 clinical trials. The first one is placebo controlled, and they're looking at 6-week endpoint for did your depression improve after 6 weeks. So because it's placebo controlled, I think this one's almost certainly going to be positive, because it's almost like the exact opposite of a placebo effect, because people who get the drug are going to know they're on the drug, and people who get placebo are going to know they didn't get the drug. And so well normally it's blinded and nobody knows, and so placebos tend to go up because they're the people feel better because they think that they got the drug. They think they got the drug. People on placebo are definitely going to know that that they didn't get the drug, and people on the drug are definitely going to know they did get the drug. And so I think this one's likely to be positive. It's supposed to read out in the second quarter of this year. The second one is probably just as critical for getting approval. And that one, what they're doing is they're testing 3 different doses of the drug. So the idea is, in theory, the highest dose people should respond more than the lower dose, but everybody's going to have at least a little trip, I guess. And so it'll be less placebo. It won't be quite placebo controlled. It'll just be they're looking for improvement as the dose range goes up, and if that happens, then the FDA can feel more confident in the first trial. If the first trial is successful, that it was really because of the drug and not just because of the anti-placebo effect. And that's a 26-week readout, and so that one won't read out until the second half of 2026. So this is one where you're just going to have to sit and wait. And it's probably not going to go anywhere. I mean, it'll probably go somewhere if the first clinical trial is successful, but I'm not sure that really reduces your risk all that much, since I said I already think it's going to be positive. In my view, that the positiveness of the clinical trial should already be priced in for the most part. And so if it jumps up, that's probably not a good that's not a good time necessarily to jump in, because you're taking on, you haven't really reduced your risk that much, because it's going to be the second clinical trial that's going to be a lot more important.
All right, Brian, we have breaking news, and it's only breaking because I obviously don't keep up in current events. Shotgun Santa says that the Montana House killed that bill anyway, so we don't have to worry about that. So there you go.
Right.
Apologies. I had seen the headline a few weeks ago, and well, I won't tell you what I thought. But anyway, it's good to see we don't have to worry about that. David Dudash. David, I don't know if I can answer this exactly, but it's a decent question to talk about kind of what the Fool does and everything. It says Shopify, SHOP, is down today on a downgrade from a small firm. Big deal. But I wonder if there are ever similar headlines when the Fool says buy. Never seen it. I said at the top, we're contractors, and I don't want to speak for the Fool, but it is sort of a different business. Motley Fool, when they make a recommendation, they are trying to make it for their members. So it's kind of a closed shop. They do not want to advertise that to the world because they don't like that. They want you to buy in. They don't want, you to have to buy it at a higher price because everyone saw it. That's a different model than the sell side analysts that do upgrades and downgrades, that it's somewhat proprietary, but they want it out there. So that's why I think you don't see headlines. If anything, I think, Motley Fool would rather people not front run them, or not they could kind of give their members that are paying good money for the value, and not just the general public. I have seen it some, though. I have seen it when there is a big call, but I think that it's a little bit of a different business, and so that's why you don't see that. And I don't know, Brian, if you have any other thoughts there, but it's a neat question, because it kind of speaks to sort of the nuance of what Motley Fool does here versus if you're the analyst at Citigroup putting out a change in your price target or something.
Yeah. And I don't know. So there's some people who go and report our information. I mean, if you Google, Motley Fool picks, if you scroll down far enough, you can find people that have disclosed their picks, and we sort of, I mean, it's almost advertising, right, for us. And we think the value in it is the actual content that we give you, the reason why that we think it's a strong company, not and to buy at this time, versus just saying, it's we think it's a buy. That's not as valuable, I think. I mean, I hope people aren't buying things based on somebody saying it's a buy without having any more information about why they think it's a buy. I mean, I think that's a bad.
Very good. Yeah, David, trust me, we want, I can't speak for Motley Fool, but we want you to know about that, not necessarily the world to know about that, because, I mean, that's hopefully the value you're getting for paying for being a member. Yeah. All right. What else do we have here, Brian?
There's a question about Pfizer.
Yes.
When
will they come back?
Yeah, they want your
good question
too. So they said to both of us, but I'll give mine, and you can punt if you need to. I think Pfizer is, in a slump because of drugs going off patent, and then also the spike from COVID-19 has pulled back, and so they're not selling 9 billion, they're only selling 2 billion approximately of sales of their vaccine and their Paxlovid, the treatment, and so I think that's the downside, and the reason why the yield is so high, the dividend yield is so high, is because people aren't necessarily expecting the price of the stock to increase that much. But they do have 4 regulatory decisions expected in 2025 and 9 phase 3 readouts. So hopefully those would result in approvals in 2026. And then they've got 13 potential pivotal programs to start. So there'll be phase 3, or if it's a high need market, it could be a phase 2 clinical program. But pivotal means that's what they expect the FDA will accept for either an accelerated approval off of a phase 2, or a actual approval, full approval off of a phase 3. So I think they've got a fairly decent pipeline, and they still have a lot of cash, and they're still generating cash, and they're giving some of it to shareholders in the form of dividends, but they've also got plenty of R&D that they're planning on spending in 2025. And so I think it's it's a multi-year. You should expect a multi-year comeback and be content with holding on for the dividend in the meantime. I think that's the best way to think about it, and think about it as it's down so much that the dividend will probably support the price. It can't drop that much more as long as they keep the dividend the same or raise it. The price won't drop that much more because at some point, the return on for just the dividend is good enough, given the low risk of it, crashing for some reason. And so I think that's I think the way to think about Pfizer.
That makes sense. We as a household are prohibited from being involved in healthcare stocks, so I don't follow it close just because it can't make me money. But yeah, now Pfizer I've heard of, and I think what you say makes sense. Jimbo has a question. Unfortunately, I have the same question, Jimbo, but I'll try and answer it anyway. Lou, what's your view on Cellebrite, CLBT? And Brian, this sounds like a biotech, but it's actually not. Cellebrite, that'd be a good biotech name. What'd you make of their latest report? Cellebrite, if you don't know them, and you probably don't because it's a pretty small company based in Israel, they are really good at phone hacking. They provide tools to let law enforcement and private investigators get into encrypted systems. It's unfortunately a growth business. Most forensics involve a digital element. I think it's about 95% of cases have something digital. The stock is down, and actually maybe let me just give actual numbers here. Yeah, stock's down. Gosh, about 25% since earnings. Now, it was a real overperformer. It was up, I think, about 100% heading into that. But it's a young growth company. They targeted, I think, up to 25% annual recurring revenue growth this year. They continue to grow. I can't really explain the post earnings move other than, maybe expectations were just that high. I mean, this is a company, it is a small company. There are risks. I think it's incrementally harder to do business with government entities, especially on the federal level, but also in the state and local level, when you are a foreign-based company versus, say, an Axon or something that is U.S.-based. But they've done a pretty good job getting by that. I wonder if expectations were too high. I wonder if it's some of this Doge stuff that we've brought up. Just, like it feels right now, the vibe is the government's never going to spend money again. So maybe that's weighing into it. But I think Cellebrite is an interesting candidate for what do we always say, like a small part of a well-diversified portfolio. I think it's still pretty fairly valued, arguably. It's going to need growth to justify the valuation. I think it'll come, but there is risk involved. And what I made it of, I certainly didn't see down 25% signs in their latest report. So I can't really explain the stock move other than, like we're seeing with Axon today, like we saw with Trade Desk last week, like we've seen on a bunch of other companies, Palantir, these stocks that are really, really priced, quote unquote, priced for perfection. If perfection doesn't come, you see an oversized reaction. So maybe that's what's going on here too. All right.
So Mark asks about Eli Lilly. Is the current climate affecting them? I think it's overpriced. I mean, yes, it's growing sales quite nicely with their obesity drug, and they do seem to be doing better than Novo Nordisk in that arena. But it's priced at price to sales ratio of 17.5, which is pretty expensive for a pharmaceutical company. Now, yeah, it's growing. It grew revenues in the most recent quarter at 44.7% year over year. So that's, obviously quite a bit. But I think, it's got to come down at some point, and they're going to have more competition from other obesity drug candidates that are going into phase 3 in the coming years. So maybe those clinical trials are going to take a year and then another year to get approval. So, think 2 years from now, there could be another 3 or 4 drugs on the market. They do have a oral obesity drug, and I think if they can get approval, if that one's supposed to read out this year, and if it's positive and the tolerability is good, then that would make me more interested in buying it at a market cap of 786 million, a billion, excuse me. So that's I think that it's risky in that if that's not successful, then they have potential for a lot of competition upcoming. If it is successful, then now they've got a new drug too, so that would help them substantially. So I think, I don't know, I just feel like it's a little expensive, especially when you compare it to Novo Nordisk's valuation. So Lilly again is at 17.5 price to sales ratio, and Novo Nordisk is at 8.9. So I mean, they're not necessarily growing at the same rate, but it's Novo Nordisk's revenue quarter in the last quarter, year-over-year growth was at 28.8%. So certainly Eli Lilly is growing faster, but that just means that it's also more potential to go down quicker because the growth rate has to slow down eventually as more and more people try the drug and either go off of it or hit their goal weight and then go off of it, or just the number of patients that have already tried it, will a number of patients that want to try it is going to go down over time because we're working off of a smaller base of patients who haven't tried it yet.
Gotcha. So a couple real quick to that. Matt had asked our dividend guys, even though it's only like 1% yielder, have you ever looked at AerCap Holdings, AER, as a recommendation? Lou's always gushing about the stock and business. Gushing, I think, probably understates it. Yeah, I do like that business, Matt. I don't know if they answered that, if they've looked. As you say, I think it's less than 1% yield. Now, they just started, I'm not sure if we're even at the 1-year anniversary of their dividends, so we are going to see that yield tick up as they go. But this is mostly their cash returns. Brian, not too bad. They've bought back, or they've reduced their share count by about 20% in less than 3 years, in a little over a year and a half. That's where most of their cash is going. I think as long as I said a few hours ago that I think their book value is understated, just based on the assets they have on their books and what they value it and what the real world price is. And they are trading for about book value. I think unless one day that changes, their primary focus is not going to be on dividend. It's going to be just taking the thing private one stock share at a time. Another real quick, just from earlier, Quill, Luda's HEICO, HEI, deserve a spot in that basket with AerCap and TransDigm. HEICO is a component supplier, similar business to TransDigm, TGG. I personally prefer TransDigm, but part of why I don't own HEICO is because I own so much TransDigm and it feels like overlap. HEICO is more diversified, which helped them during COVID when there weren't a lot of need for plane parts. They also made electronics that went into a lot of the medical devices that were being used to keep people alive. So their revenue held up better then, but that over time has tended to be lower margin revenue than what you can get with TransDigm. HEICO is a fine operator. It is probably, in my mind, second best, but a strong silver medal. And a lot of people disagree with me. There's a lot of people out there who like HEICO over TransDigm. And I certainly, though I respectfully disagree, I certainly get that. It's a fine company. All right, what else we have here, man?
Jimbo asks about catalysts for Schrödinger. The ticker there is SDGR. They're reporting earnings next week. So this is a weird company in that they sell software to help biotechs and pharmaceutical companies design drugs. So they have proprietary information that they start with the protein structure, and then they try to, they do a whole bunch of different combinations to try to find drugs that will block the active site of a molecule or activate the active site of a molecule, depending on whether you want to block the activity of the protein or enhance it. And so they were doing that for a long time, and they were quite successful as a private company. But then they started to get in the drug development business, and so then they had to IPO because they needed a lot more cash to develop drugs, and so they IPO'd a few years ago. And so now it's this weird combination where they have money coming in, and then they're using some of that to grow that that software business, and then they're also trying to siphon off some of the money to fund these clinical trials. So their pipeline is actually quite early stage. So they have 3 phase 1 clinical trials that are supposed to read out in 2025. They have one for B-cell lymphomas, one for acute myeloid leukemia, and then a third one for solid tumors. So all in the cancer space, two in blood cancers and one in solid cancers. So it's really early stage. So it's sort of hard. I don't usually put any value on drugs that are in phase 1 that haven't read out phase 1 data. That's essentially preclinical still, and its valuations at $1.7 billion. I don't think they give guidance on what they expect for their revenue for their software business. So I don't know what the street is expecting for revenue from the business, but they also have some partnerships and they get some milestone payments from that too. So, and those are kind of hard to value as a investor because you don't know exactly when they're going to come in. So overall, I'm not a big fan of this company, mostly just because I have trouble valuing it. I mean, I think they're a good company. I just wish they had stayed in the software business and not tried to go and develop drugs, and just let somebody else develop the drugs, and they could just benefit from those companies, from their software being successful, and therefore helping those companies develop their own drugs.
There was a question, I can't find it now, but a while back, about Comfort Systems USA, ticker FIX. And this is one that has been popular over the last year. It's an industrial company. They do HVAC systems, but sort of like MCOR. The thesis behind it became it's a pick and shovel way to play the AI boom. Because what do data centers need? They need a lot of air conditioning, and the people who wire the electronics for the data centers, that's a huge market. I don't know if I think they actually started from a higher base than MCOR, so I don't know if they quite climbed as much as MCOR did, but they were up, I believe, close to a double in a year and have fallen back to earth. Earnings coming out. I'll say this. I think with MCOR and FIX, MCOR I'm a little more comfortable with just because the breadth of its holding. I think there's a lot more ways for them to win. I do worry about industrial companies sort of getting caught up in the frenzy because there are natural limits to how fast these things can demand. You can, if you're Facebook and you figure out the Facebook app, scaling that app is quite simple. In the industrial world, including data centers, for all the talk about NVIDIA getting orders for chips and delivering on chips, there are physical limits to how fast that work does. And the companies that are get paid incrementally as that work is done, there are natural limits to how much they can grow. So I think valuation, even if the thesis is correct, and this is an AI play, and there will be more demand for their services due to the demand for more data centers that need more electric wiring, HVAC, all of that. Be careful with valuations because X number of data centers are going to get built in any one quarter, and that's going to mean some percent of X in revenue in each quarter, no matter what the demand is. And if you lose sight of that, and see this is going to go up the way the software companies and even just the orders for chip companies go, you tend to overpay. So we'll see what they say in their earnings. I think their earnings are tonight, but interesting company, reason to be caught up in it, but there are natural limits to how much they should benefit from this.
David Dudash says there's also something called a nocebo effect. And I guess this is a new one to me, but according to Google, it sounds like it's a phenomenon where a person experiences negative health outcomes due to their belief that they will experience those outcomes. So basically, like you feel like you're going to be depressed, and therefore you are depressed, which I guess kind of makes sense. Especially when it's a psychological thing. I don't think you thinking you're going to get cancer, the chances that's going to cause you to get cancer, I think, are pretty low. But I think it makes a lot of sense for things where it's psychological. And I actually tend to not invest in companies that are developing psychological drugs for that very reason, because you see a lot of phase 2 clinical trials that are successful, and then they go into phase 3 and the drug performs just as well as it did in phase 2, but the placebo group does much better in phase 3 than it did in phase 2, because of course everybody's in the clinical trials Googling the drug and seeing that it worked in phase 2, and therefore they think the people that are on placebo think some percentage of them think they're on the drug, and they feel better about it, and feel better about themselves, and therefore they end up having a higher placebo effect. So I try to not invest, or I just basically don't invest in psychological drugs that are in clinical trials. I would certainly buy one if it was already on the market and had had gotten approved. I think that's that there's plenty of opportunities to improve the psychological issues, but I just don't think that I think it's very risky to hold on to a stock through phase 3 clinical trials. I've just seen so many fail because of that reason, because the placebo effect is just much better in phase 3 than it is in phase 2.
Isn't it too? And maybe I'm just showing my ignorance here, but if it's a new cholesterol drug, you can take my blood and count my cholesterol and know or get an idea if something's working. If I break my leg, you can do an X-ray and say, okay, it's healing. There isn't really, for some of these, the brain is very complicated, and you can't just do a blood test to see if a drug is working on some mental thing. It's just the whole thing is it's just a different, almost a different game to play as someone trying to look at it and figure out, is this working? And I'm probably oversimplifying, like a new statin. You could just look at that versus the old statin and figure it out. But it just feels like it's so much harder in that mental health area to really get effect and to really say what's going on just by the nature of the disease. Is that true?
No, I think you're completely right. Pain would be another one where you see a lot of placebo effect, and it could vary from test to test, from clinical trial to clinical trial, and it just sort of just depends on how much people think that they are benefiting, and it's hard because you're just asking the person, how do you feel, right? And you can feel better for a lot of different reasons that have nothing to do with you taking a medication. And so, I think that's...
By the way, the nocebo, my wife would say that's me every time I get a vaccine, because I've just convinced myself that I'm just going to be tired the next night and grumpy, but it's probably an excuse to be grumpy. But there you go. It's real. All right, back on course now. I saw one, and it was okay. Yeah, it was about Brookfield, and I certainly can't answer the second part of this question, and although I think we can guess, but it was asked. Veritas Research Corp has a sell recommendation on Brookfield, BN, based on overstated growth drivers, earnings quality, and cash flow. It says, is the Motley Fool still comfortable with that rec? I think that's something to, on an individual service level. I think if they're not, you'll know, is what I'd say. But I will say, as someone who's followed Brookfield for a long time, I don't know. I own the stock. I couldn't really honestly tell you valuation right now because it's not one that I'm looking to jump in or out of. They are very, very smart operators, and they can give you exposure to a lot of things. Now, Brookfield is a whole range of companies, and this is more just on the management side of it versus like, their infrastructure or something or renewables where they're focused on a space. But I can't tell you if Motley Fool is comfortable. I can tell you that as a holder of it, I am comfortable being a holder of it. And there are times when things can be, there are ups and downs with this business, but they are pretty much a steady as you go operator. And if Motley Fool isn't comfortable with it, I'm sure you'll hear about it sooner rather than later.
Vihan asked for gold, silver, bronze from a list of companies. Chimera, Arvinas, which I don't follow, so I can't rank that one. Pfizer, Sanofi, and C4 Therapeutics. So I don't follow Sanofi that well, but between Pfizer and Sanofi, I would tend to go with Pfizer just because the dividend yield is so high right now that I think that the turnaround prospects for the next few years are decent. So I think you could have a decent return between the current dividend plus the thing. I own Chimera. The company is developing protein degraders. So they work by using cells have a natural way of degrading proteins that become misfolded. So they throw ubiquitin onto they put a long chain of ubiquitin onto the protein, and then that tells the cell to send it to the lysosome where it gets chewed up. So what Chimera is doing, and also C4, they are working on developing these small molecules that bind to the protein that they want degraded, and then that attracts one side of it binds to the protein, the other side binds to the enzyme that adds ubiquitin, and so then it adds ubiquitin, and then it just then it just cascades into the thing. So basically, they're able to get rid of a protein the same way that an RNAi does, where they inhibit. In that case, they're inhibiting at the RNA level, or the mRNA level. So they're binding to the mRNA and degrading the mRNA. And if you don't have mRNA, then the protein can't be expressed. So they're getting rid of it at the mRNA level, and you're not making protein. Versus these companies the proteins are getting expressed, but then they're immediately getting targeted for degradation. And so that's how they lower the protein levels of proteins that are perpetuating a disease. So I would go with Chimera as my gold, and Pfizer as my silver, and maybe Sanofi as my bronze. Again, I don't know our Venus, and then C4 I think is pretty early stage, and so I'm not that excited about it.
Gonna hit something probably from the last hour when Danny and Tyler were talking Palantir, but Jimbo, as I said, high valuation makes it more fragile, so any unfavorable news could drop it. Talking about Palantir, PLTR. I don't think the Department of Defense cuts will affect Palantir that much. It saves the Department of Defense money, and Musk supports it. Jimbo, just a couple of thoughts on that. I agree very much with the first part of your statement, and that we said that before about other things, that when companies are priced for perfection, anything that goes against that, any little nick on the polish, tends to cause an oversized reaction. I do think that's what's going on. The weird thing about this to me, though, continues to be that it trades at 30 to 50x what any other defense contractor trades. So even though government is more than half of Palantir revenue, you could never at any point in its history justify its valuation based on the government side of the business. And if anything, if this valuation that it still has today, even with its downfall, if it is to be justified, it is going to be that commercial grows so much that it just dwarfs defense. Defense can give you pretty standard high single-digit growth, period. The government is not going to give its whole budget over to Palantir. I would argue with you that Palantir does not save the DoD money. One of the problems they've had is that what their software does, it's the only ones who can do it. but you only want to use it for those purposes because it is so expensive and so complex versus off-the-shelf tools. So that kind of boxes them into, you only want to buy it when you need it. At the end of the day, if this stock is going to live into the hope for it, it's going to be based on its ability to rapidly grow the commercial business. So I do think this Doge thing and their drop is well more than it probably is to the bottom line. But I really almost think that at these valuations, the government business needs to look almost irrelevant in the years to come, which makes it all the more weirder that it would drop 20% on a potential change to the government business. All right, about 10 more minutes with Brian and I. Brian, what else do you see?
David asks about GRX. I'd never heard of this company before. It's called Gabrielli Healthcare and Wellness Trust.
The Gabelli, so it's a fund. It's an ETF, probably?
Is it? I don't know if it's a, yeah. Well, I don't know. It's got an earnings per share on it, so I don't think.
Oh, it's a closed end. So yeah, okay. It's a closed end mutual fund. So yeah, it's a collection of investments, but it's closed end, which is why it can report. Sort of like the same way, though this is a terrible oversimplification, but the same way that Berkshire has to adjust its based on its holdings because it is similar. But yeah, this is so their biggest holdings are Bellring Brands, AbbVie, Tenet Healthcare, Johnson & Johnson, Cigna, Merck, Stryker, Post Holdings, United Healthcare Group, and Teva Pharmaceuticals. That's their top 10 is about 25%. I don't know if that gives you any insight into it.
Yeah, I mean, they're mostly investing in large pharmaceutical, large pharmaceutical. Most of those were pretty large pharmaceutical or biotech companies. The dividend's like 7.4%. But, I guess, and I don't know, you think that's just a pass through or?
Yeah.
I mean,
it looks like, they paid out in February 15 cents per share.
Right. So it must
be on a net SFA of 11.39. So yeah, that works. Yeah, no, I think that's it. Or it's closed end so they can buy and sell in and out of that and pay that off, or the pass-through dividends. Probably. I don't know this one well. But yeah, Fools, the one thing I'd say, and I don't see it real quick, maybe if I click through on the fact sheet, a lot of these closed-end funds, just be careful of the costs because you are probably paying those managers pretty well to pick those stocks, with mutual funds, with ETFs, whether they're open or closed. That's where it gets you. Because if the market's going to make you 7% and they promise you 10, but they're taking 4% in fees, that's kind of lazy math, but you get my point. You're not really getting any benefit from here. Full disclosure, Gabelli, not these guys, but I at times help out with the Gabelli family of funds and some of their other things. They're good people, but these tend to be expensive. So there are cheaper baskets. If you just want a basket approach to healthcare, I'm willing to bet you can find cheaper ETFs that will give you maybe not the exact same thing, but you also won't pay the price for it. So I don't know.
Sounds reasonable.
All right. So Facebook is committed, or Meta, I can't say Facebook, right? You see, I'm old. $50 million to the Horizon Creator Fund. Sato says they're still trying to make the metaverse a thing is kind of my take on that. Maybe I need to see more, but definitely they will need to invest probably all of that and more to get creators in their environment, and they have the money, so why not? Without knowing more, that would be my thoughts there. David Didish says, should we be building so many data centers, energy black holes and wasteful, using Bitcoin to buy a car? I wrote a check recently, not much energy involved. Yeah, there's a lot to unpack here, David. I don't think we're ever going to use Bitcoin to buy a car, and I think that's separate from data centers. But yeah, I struggle with Bitcoin as a store of value when it remains as volatile as the NASDAQ. I personally want my currencies to not be that volatile, and maybe it'll get there, but I don't think we're building those data centers to use Bitcoin to buy a car. It's all about AI. The parallel I would use and this isn't the negative, but those of us who are old enough, and Brian, you're Southern California, right? Because this was the entire
Yes.
or no, are you not? I thought you were.
I'm in San Diego. Yeah.
Oh, San Diego, that counts as Southern.
Yes.
It's
About as Southern as you can get before,
right around the corner.
Talking
from
national
Ryan's
city. I guess
Yeah.
if I was, national city is on the border or imperial.
Right around the corner from his house, I'm sure, because I don't know where he lives, so I'm just saying. But was a company called JDS Uniphase, and there was a whole boom in the late 90s to build up telecom fiber because the internet was going to eat everything. And we just needed so much more capacity. And that didn't exactly play out the way we thought. JDS Uniphase, they're still around, but they're not what they were. Global Crossings, Leap, all of these things that were building out all that fiber. But guess what? Brian and I are talking to you today basically because of that overinvestment. Eventually, all of that fiber got used. And I get the thing on energy, and I think the data centers are trying to be more energy conscious and use more renewables. Do we need all these data centers? We will see if we need them today for AI. But just like it turned out, we didn't need all those cables under the ocean until we did. I am not going to bet against human ingenuity to figure out cool things to do with these data centers once we have them. So I'm not going to worry about whether or not we are overbuilding in the short term. I do think as an investor, though, you better be careful of that. I will concede that. But long term, I'm not going to let us having to solve our energy problems, which we need to do anyway, keep me from wanting to see a build out in kind of the capital for creativity in biotech, in industrials, in everything else, just better computing power, being able to solve hard problems. So I'm bullish on humanity, Brian, even if I'm not on some stocks. And David says he found GRX by mistyping GTX. GTX I have opinions on, David. Personally, if it was my portfolio, I would rather look at GTX, but I don't know. Maybe I'm selling the belly short. All right, what do we have here? Oh yeah, yes, as David said, yeah, the JDSU. There are a lot of great charts for that from those days. But yeah, the JDSU chart. Do you remember them, Brian?
No.
Okay, man. Yeah, that was a fun time. We were all gonna go. Yeah, and again, most of that fiber sat unlit for the better part of a decade, because we totally got the .com era wrong. And yet look at it. It's all in use today. And I do think that's worth remembering. It didn't really help the investors in JDSU. So there were limits to its usefulness as an investor. But I tend not to worry about companies investing cash that they have to solve hard problems, because it tends to work out eventually for us all, even if it doesn't work out in the moment or for the quarter.
Do you follow NICE?
I don't.
Okay. There's
I don't.
5 questions on it. So hopefully somebody comes along eventually and talks about it. It's a customer relations management software using AI, but I don't obviously follow it. But I just figured I'd ask, since I think
I saw
3 or 4
that.
questions about it. I guess they released earnings this morning and it's down 15%. So.
Yeah, Jimbo asked Danny about Axon. Axon's down big over the last few days. AXON is the ticker. And it was some very, very small boutique analyst shop, but which they can be a lot smarter than the big banks. So I don't mean to criticize, but basically saying that a company that I, as an Axon shareholder, had personally never heard of, called Flock, is having a little bit of a divorce with Axon. They were partners, they were integrated, and now Axon thinks they're becoming more of a frenemy where they're competing, so they are separating. And the analyst thinks that this could weigh on earnings, and so therefore it was a downgrade, and the stock is off 20-something%. I say I've never heard of them, just because I think the actual analysis, what it will do to the business, is probably overstated in the stock's reaction. That said, to kind of just sound like a broken record this hour, when things are so price for perfection, any little bit can count. What we learned last week with the trade desk had hit their internal targets for 33 straight quarters as an independent company. They missed their targets for one quarter, and they lost, 30% last week. Axon is on a similar valuation trajectory as one of those companies. So even if this does cost them a penny or two on a very profitable quarter, it could be an oversized reaction, and I think people are sensitive to that. Axon has always looked overpriced to me. I think one day they will have a quarter where you pay the piper on that. But that is a company that, unfortunately for society, there's a great need for. They've done a great job expanding their business, and they have also done a great job layering more products. So you're not just chasing new business. You're continuously able to add sales to existing customers. They went from the taser to the body camera to the evidence management system. Now they're going to sell you a drone for the police department. Their ability to layer more value onto their existing relationships while still chasing down new business is the catalyst for the kind of amazing multi-year growth we've seen. I don't know what this quarter and the next quarter will bring. I don't know if the valuation is sustainable over the next 5-10 years. So there could be a trade desk-like day in its future. We've kind of had it in advance, I think, in anticipation the last few days. But for a long-term holder, it is hard to look at this and say it's time to panic, or it's that the growth story is over just because a small partner isn't going to be selling their stuff anymore. I think it's funny. I think the reaction is more to do with the valuation going in than it is the actual news. So we'll see. All right, we are just about at it, Brian. Anything else you need to get in before the end of the hour?
No, I scanned the ones that were from old times, and I think I've, at least on the popular list, there was nothing on my thing. Oh, BridgeBio, yeah, I talked about this at the top of the hour, Ed. So you can go back and look at it, but it seems like the company, they released earnings this morning, and they seem like they did pretty well with their launch, at least in the first month and a half, or I guess it's 2.5 months of since their launch. They've got 1,000 patients on the that have been prescribed the drug, so that's a pretty good start, I think. It was up like 10% today, but then it pulled back completely, at least when I looked at the top of the hour. So I think it's a good company. I like it. It's been a biotech. It was a recommendation in biotech breakthroughs. So I think I think they have a strong pipeline, and then with one drug on the market already, I think that's it seems like they're starting off in the right direction. It's still early stage, but I think the valuation doesn't seem too lofty.
All right. Well, one more I'll get to real quick, and I can't really answer it, but Ken had asked about Lululemon, LULU, Canadian and potential tariff impact. Fools, anyone who's seen me on the street knows I'm the last person to talk about high-end fashion, and Lululemon to me is high-end fashion, so I won't really speak in the business. But one thing worth remembering with these tariffs, and there's so much unknown, is that the tariff is only ever going to be on basically the production cost. And so things with a huge markup. So like if you bring something in at $10 a unit manufactured, you ship it to a store, the store does its markup, the company does that markup, and by the time the consumer gets it, it's a $50 item. The tariff is paid on the 10, not the 50, which just, and I apologize, I'm oversimplifying, but basically, I don't know. It's really hard to predict how much that will move the needle on demand on especially things like fashion and stuff, because we're not talking, it's not just as simple as saying if it's a 25% tariff, expect the price to go up 25%. And that's why it makes it really hard to predict the future on these things. So I think in general with tariffs, slow and steady, don't get too caught up in the day-to-day, and over time it'll work itself out. All right, on that note, someone who's always wearing Lululemon and looking great, and Rachel, both of you right here.
I love it.
Yeah, it just seemed too easy though, didn't it? Yeah, sorry. All right.
Thanks, Lou.
Thanks,
Brian,
guys.
thank you. Danny, Rachel, have fun. Thanks, fools.
Bye, guys.
All right, fools. Well, welcome to another hour of Fool24. I'm your co-host on deck today, and I'm joined by Danny. How are you doing today, Danny?
Life is good.
Glad to hear it.
Surprisingly.
Well, today, fools, our theme is the most important investing questions, and I'm curious to hear, each of our sort of respective approaches to talking about this idea. But I think we're going to just broadly speaking be going through some of the questions that we think about when we're evaluating companies and looking at stocks. But we also want to hear questions from you guys, your most important investing questions. So go ahead and get those in the Slido, event code Fool24. I also see we have about 170 plus questions in the queue right now. So we're going to do our best to hit any of those that we are able to answer in the next hour. So I don't know, Danny, maybe just to start off and kick it over to you, and then I'll respond and share my thoughts. When we're thinking about this idea of the most important investing questions, I know we both have a real mixture of stocks and companies in our respective portfolios. I know we both like a lot of these tech growth businesses, among with many others. What are some of these questions that you are thinking about as you have built out and continue to build out your portfolio?
When I'm looking at a company for investment, there are a number of questions that I ask myself when I'm looking at the company. One of the things that I like, and my portfolio reflects that, is I like to see a company that is consumer facing, which means it has a really large addressable market. I think that there are a lot of companies that are business to business type companies that also have a great addressable market, but I don't think you can beat a company. And I'll use Apple as an example. This is a company that offers the smartphone that started it all. And the iPhone has become not only iconic, but probably one of the most pervasive electronic devices on the planet. I think last time I knew, Apple had more than 2 billion active devices overall, and more than 1.1 billion of those were iPhones. So, this kind of just use that as an example of the opportunity that exists in a consumer facing environment. So that's one. But I also like to ask myself, what does the company bring to the table that might be a little different than its competitors? And to use Apple again as an example, Apple always focused on the high end of the market. They were always creating and selling premium devices. Now, there have been times since then where Apple has come out and said, yeah, we're selling an older generation device, or we have created this device for the lower end of the market. But still, Apple makes the vast majority, the lion's share of its income from the premium devices that it sells. And because it has that premium, and because consumers view it as premium, they can also command a higher price point than many of the competing devices. So that's another thing that I like to look at. And finally, I like to look at management and look at how they focus the business. What is their strategy for the next 5 years down the road? How are they going to continue the business along a growing and profitable trajectory? And Apple is one of those companies. It was funny because when we lost Steve Jobs and Tim Cook took over, there were a lot of questions about whether or not Tim would ever be Steve Jobs, and I think that was the wrong question. Tim Cook was the operating officer, and he was the one that made sure that things got done on a daily basis at Apple. So my question was, would he continue to do things, the way he had done them? And the answer to that was yes. And I think that is the reason why Apple has continued to be so successful in the ensuing years, because Tim Cook didn't try to be Steve Jobs. Tim Cook tried to be the best Tim Cook that he could be.
Yeah, I love all of those thoughts. It's interesting because I know there's a lot of overlap in some of the types of companies you and I gravitate towards. And there are a lot of questions that I think about specifically when it comes to, building out my portfolio, as I try to take a methodical approach and keep emotions out of it. And as I've mentioned, I started my investing journey about 5 years ago. So I'm a little bit newer than, perhaps some of the other, fools on the stream. But one of the things that I think has been really helpful, starting out and then, building on these things over time, is trying to understand what my investment goals are and understanding how the investments I make fit into that broader trajectory of my goals, not just 5 years from now, but 10 years from now, 15 years from now, 20 years from now. None of us can predict the future, but doing our best, in my best, to plan, for my financial future is something that I have really kept in the background of my mind as I build out my portfolio. And a lot of it has also come down to, we've talked about this concept on the show before, but really investing in what interests me, as well as just fundamentally businesses that I understand. There may be a business that a lot of other investors like, but if I don't get it, if it doesn't make sense for what I'm looking at for my portfolio, I would be hesitant to put money to work there. I'm only wanting to put cash into businesses that I fundamentally understand how they work. How does their revenue and profits, how are these derived? How does their industry work? What does the competitive landscape look like? What is the moat of this business? What is their growth runway looking over the next, 5, 10 and beyond years? And how am I looking at this investment as a way of generating growth for my portfolio? Am I looking at it for, a dividend income, for example? Am I looking primarily for, growth through share price appreciation, capital gains, interest? These are all things that, may sound really simple, but I really think about now. More broadly speaking, looking at businesses, as I mentioned, one, it's really understanding the business and being interested in it. I like to invest in things that excite me. I talk about healthcare a lot on this show. It's a space that I'm been reporting on for a number of years now. And it's also one that I'm really enthusiastic about and really interested in. And I have tended to gravitate towards those types of businesses in my portfolio. And I actually think that's one of the things that I have found, so enjoyable about investing for the long term is there may be a really great company that I'm just interested in and enthusiastic about, and I can become a part owner of that business. And that is an exciting opportunity. I think something that is also important is, we talk a lot about diversifying among different stocks and sectors. And I think something that's also important is from time to time looking at my portfolio and seeing if I need to rebalance anything. If I am overly concentrated in a particular company that doesn't maybe quite fit in with the risk level and assessment that I've set, for my personal portfolio. And is my thesis still holding true for these stocks as when I bought them 5, or more, years ago, as time goes on. And I think also checking my portfolio, several times a year, even if it's just once a quarter, to look and see if things need to be rebalanced, and also evaluating that within the broader landscape against which my portfolio is operating, whether that's changing interest rates, we talk about recession risks, stock market ups and downs, short-term market movements, 1 or 2 financial reports aren't usually things that are going to cause me to change my thesis, or, change a position in a company that I own. But I always try to be aware of what is going on in the background so that I can check my portfolio from time to time and really ask myself, okay, is my thesis still firm for this stock? Is this a company that I want to add to? Does my position look good as it is right now? So these are some of the major questions, that I ask myself and that I think are important to consider. We had a question from Ed that came in, and I think we can probably both offer some thoughts on this. Ed was asking, are tech stocks in correction mode? And it's interesting because we've obviously seen some volatility, broadly speaking, in tech stocks recently. We know in January there was for example, labor market data that had come in for December that was hotter than was expected. There was investors then scaled back their expectations for Federal Reserve cuts. There's also been an impact on tech stocks recently, even as recently as end of January, early February, with the announcement of DeepSeek's large language model, and that affected share prices of a lot of these types of companies. I definitely don't think that we are currently in a tech correction. We know that over the last couple years, tech stocks, these growth-oriented businesses, have broadly led the market. In January, they lagged the broader S&P 500, partly due to some of these different factors that I mentioned. And then we've also been dealing with just a constant influx of news that can affect a lot of companies in different sectors, including in tech, whether it's news about tariffs or otherwise. So I think there's been a lot of uncertainty in the market. A lot of the investments that we've seen, they have potential ramifications for businesses across sectors. I think there's a lot of ways in which people immediately are looking to tech to see what those potential impacts might be, whether it's chips or AI, or just uncertainty about the market moving forward and how that's going to impact corporate bottom lines, right? Issues like tariffs raise a variety of questions in that area specifically, and how those input costs go up for companies that are already historically very capital intensive, and especially ones that have significant overseas manufacturing and supply chain exposure. So these are some of the factors you're still seeing. Now, there's still a lot of tech companies that, if you look back over the last 2, 3, 4 years, are still doing really well and have compounded beautifully. But I think that this is an area that has really always, and especially in the last 5, 6 years, reflected some of the volatility among consumers and investors. And I think that's something, that we're seeing right now. But looking at individual businesses, I still think there's a lot of great opportunities. What are your thoughts, Danny?
I wanted to share a chart here because, and just so that we're all talking about the same thing. So a correction is generally when a market or a stock is down at least 10%, but less than 20% from its recent peak. So when you're talking about a correction in tech, it's best to look at the NASDAQ, because the NASDAQ is the tech centric index. So I'm going to go ahead and pull a chart here of what the NASDAQ has done recently. I'm going to share my screen here. And so what we see when we're looking at the performance of the NASDAQ over the past year, and you can take a look here. See, I'm not sure if folks are seeing that chart. I see it here.
I don't see it right now.
All right, let's try this one more time. Sometimes technology can be a blessing and a curse.
This is true.
All right, let's try that chart one more time, see if it comes up. Yeah, it's showing up at the bottom, but not on the screen. I'll just explain. What I'm seeing here is that from its peak, which happened in let's see, late last year, the NASDAQ is actually down 1.29%. So yeah, we're not anywhere near a correction, which is defined as a 10% move. Now, what I will say is, if you think over the past few weeks, we have seen, or even past few months, we've seen where NVIDIA stock was at one point down by 20%. It has since recovered. We've seen Palantir stock that is down 20% just over the past couple of days, the last time I looked. Last week, the Trade Desk stock fell by 30%. Axon Enterprises, and I'll give you tickers for all these in a moment. Axon Enterprises, ticker AXON. The Trade Desk, ticker TTD, Palantir, ticker PLTR, and NVIDIA, ticker NVDA. All of these stocks have fallen precipitously And to my mind, that's like 20% or more over the past several months. And if you look, oh, and there's our chart.
There we go.
Thanks for getting that up there. So you can see the NASDAQ is down about 1.29% over the, since its peak, and that peak was late last year. So what the stocks that I just mentioned have in common is that every one of those had a high valuation. And so I think investors are being less forgiving right now. When you have a stock that has a high valuation, it's subject to much greater volatility. And so what happens is any hint of uncertainty, any hint that the current trajectory might not continue indefinitely, and investors are doing a bit of profit taking. And when they sell the stock and there's less demand for the stock price falls. And that's just the nature of the beast, particularly when you're talking about high valuation stocks. So I think what we're seeing here is a greater degree of volatility. I do not think that we are in a tech correction.
Yeah, I would agree with you. And like you mentioned, it's usually it's defined as a 10 to 20% drop in a market index or individual securities. And we've seen some of these drops in shorter periods of time for individual stocks. And many of them, like you mentioned, have bounced back and forth within that area. And I think it's important to understand how some businesses tend to react more broadly to the news that might impact them. And you see a lot more robust movements within share prices than perhaps you do in other industries. And that's definitely been true in tech. And that has definitely borne out if we look back over the last, 5-6 years. But I think it's also helpful to think about the fact that, even were a correction, an official correction to happen, these are usually short term within the longer lifespan of an investing journey and within the span of the market. There's not a single correction or even bear market from which the stock market has not eventually recovered. The average market correction can be anywhere from 3 to 4 months, sometimes longer, as we've seen in recent years when there's a full-fledged bear market. But the market has a wonderful habit of always bouncing back. And the reality is, as long-term investors, market corrections are normal. They can even be a healthy part of investing. They can be something that you're going to encounter probably multiple times throughout your investing journey. And I think that both robust periods in the market as well as corrections can present opportunities for great businesses to be bought by long-term investors, especially if you're working on diversifying, thinking about how you're allocating your assets to balance market risks and rewards. These are all the questions I ask myself during these more volatile periods. And I say this as someone who, I talk about how I invest in healthcare a lot. I also invest in a lot of these types of tech stocks that are more prone to volatility. And for me, I've stuck with some of these big businesses like the Apples and Amazons and Alphabet and other companies we talk about a lot here on the show. And I have still had an incredible amount of returns in my portfolio from just these well-known big name stocks that have been quite volatile over time. So for me, even in a volatile period, I think that there's a lot of opportunity, which is exciting. Steve Mitchell said, "You're right, Rachel. Understanding is key." That's why I love stocks like Wingstop. I can understand it and eat it too. I love that.
Nice.
Yeah, their food is really good. There was one other question I saw from earlier that I wanted to answer. And I'm trying to find it now. Oh, okay, there it is. And then Danny, if you want to look through and see if there's one or two you want to grab. But Foolish Skeptic had asked 3 hours ago, which is the ticker for Realty Income, is touting itself today on the internet. Is it a good time to buy some or more? So, we're not able to give individual investing advice on the show, but I can talk about some of the factors that are moving the company and where the company's at right now. This is definitely a stock that, personally speaking, I'm very enthusiastic about and think is a great income stock. So Realty Income, they're a real estate company, real estate investment trust. They invest in commercial properties, and they lease them to industry-leading companies that a lot of us know, like Walgreens, like 7-Eleven. and many others. And they invest in a wide range of retail, industrial, and agricultural properties, not just in all 50 US states, but also in the UK. And they, I believe, have a presence in 6 different European companies. The biggest thing that seemed to be bumping the stock a bit in recent days was Realty Income announced their most recent dividend, which was the 129th dividend increase since Realty Income became listed in 1994. It's worth noting that Realty Income pays a monthly dividend. It's one of the few of these types of businesses that does that. And they have also declared 656 consecutive monthly dividends at this point. So really, really interesting business, and one that has, provided a really, I think, steady source of income to investors over the years. And as I mentioned, they have a really broad range of clients that they lease to within every sector you can think of, from retail to pharmacy clients, casino clients, a lot of different types of businesses. They have a portfolio of more than 15,000 commercial properties that they lease to over 1,500 clients in 90 different industries. I don't think they've actually released their results for 2024 yet, but in their third quarter report, they did deliver net income of about $262 million in the third quarter last year, and adjusted funds from operations, or funds from operations, which is the more useful metric when you're evaluating this type of business, a REIT. Their AFFO available to common shareholders was about $916 million. They also achieved a rent recapture rate on 105% of their released properties. This is a solid business. I have always really liked this one. As someone that tends to gravitate towards dividend stocks myself, they just have a fantastic history of maintaining and raising that monthly dividend over time. Like I mentioned, they have a really broad portfolio of clients that they lease to. And it's worth noting that triple net leases, which is something you see a lot with some of these REITs, is a really common part of Realty Income's business model. So essentially, Realty Income will purchase these different properties and then lease them to clients like I named, like Walgreens, 7-Eleven, these big resorts, different clients across many different industries. And the triple net lease model essentially puts all of the costs of operating the property and maintenance on the tenant rather than Realty Income. And so that means that Realty Income is able to divest a lot of the operating costs associated with these properties onto their tenant, and they sign, these renewable long-term leases. So I like this one. I think, again, that triple net lease business model is notable. Often these lease arrangements are for a period of 10 years or longer. This has been a pretty resilient business through the years. And again, their exposure to very different segments and industries, some of which are more or less dependent on discretionary consumer spending, I think is also something that has helped the company remain resilient through the years.
So I saw a question in the queue. It actually came in an hour ago from Ed. And Ed asked, what is Portillos' relationship with Bernelli's? Some Portillos have a Bernelli's in their restaurant and are twice the size. Bernelli's serves pasta and salads. You made me look. Portillos is a company that I've followed for a while now, but I was not aware of the connection. So I went back and looked, and I found back in 2014, there was a private equity company that was investing in Portillos, and it said, which includes Portillos hot dogs and Bernelli's pasta bowls. And then I went and looked a little further, and it turns out that Bernelli's is a concept restaurant that serves pasta bowls, and they are in some Portillos restaurants. So for investors who are not familiar, Portillos is a fast casual chain, ticker PTLO. They focus on Italian beef sandwiches, hot dogs, milkshakes, and their own homemade chocolate cake. It's been around for about 60 years. but they only went public a couple of years ago. This is one that I'm interested in because Portillos has an average unit volume, or the amount of revenue that they generate per store, that is higher, not only than restaurants in their same size category and in the fast casual space, but also much larger chains in the fast food space. So, really exciting opportunity there. Now, they've had a hard time recently because management made the strategic decision not to increase prices as much during the couple of years of inflation that we've been in. It's generated a lot of goodwill with customers, but not. But has hit their financials negatively. I think that will change here as we go forward. So yeah, apparently there is a connection between Portillos and Barnelli's, and I learned something new. So I love that about this. The other comment that I was going to address came from Sadaf a couple of minutes ago. And Sadaf says the NASDAQ 100 technology sector is still at an all-time high, but it somehow feels like it's 30% down. I don't know what to think. And the thing that came to my mind was something they call the Fear and Greed Index, which is something that CNN put out. And I went and checked the Fear and Greed Index. And we have moved from greed a couple of months ago to edging on fear, which generally means that investors are nervous and they are looking at, the potential for a market downturn, for a correction in the near term, and are worried about what the future holds. I think some of that has to do with, uncertainty in the market. Some of it has to do with high valuations. Some of it has to do with some of the uncertainty that's unfolding in the political arena. So I would say, yeah, I certainly understand your feeling like the market's down, even though we're, right near an all-time high. And I would say, hang in there, because that is part of the cost of admission to being a successful investor, is being able to sit on your hands when things are really looking uncertain.
Yeah, I think that's absolutely right. We had a couple questions that I wanted to hit that came in several hours back. One was from Irritable Investor. Do you guys have any thoughts on Ulta Beauty? Do you have things that you really like or dislike about it? So, Ulta Beauty is the stock that I follow pretty closely. They have been dealing with a few different headwinds in the last few years. You think of Ulta Beauty, and this is much more of one of those legacy beauty retailers. They've been around since the early 90s. And when they first were founded and started expanding their network of stores that I think a lot of people are familiar with, it was a time when the way that people shopped for beauty products was really different, right? And the other thing that I think is important to note, it was also a time where different types of beauty products were segmented into very specific places. So you'd go to, for example, the drugstore to buy some of these mass beauty products. For these higher end prestige products, you go to the department store. And then you might go to a salon and authorized retail outlets for things like, professional hair care products. Nowadays, while you still have a dynamic of different types of retailers selling some of these various categories of products, there's much more overlap, and it's a much easier way for consumers to purchase the products they want in beauty specifically, whether it's online or in store. There's a lot more options. You can go to one place and often get all of the items that you're looking for in one fell swoop. So it's kind of interesting to think about how that model originated for Ulta Beauty. Now, through the years, they've worked to innovate and provide their own take on what the beauty experience should look like for clients, right? So They have their network of retail stores. They have partnerships with some of these, major companies, like Target is one. And they also have, I believe, more than 500 Ulta Beauty at Target shop-in shops, which is something that's worth noting. They operate more than 1,300 stores in convenient, high-traffic locations. And so they're very, very strategic with where they place these locations. And again, one of their major sales partners is Target, and with these Ulta Beauty at Target locations. So that's something that I think is worth noting. And they do offer a wide selection of categories, from mass beauty products, which are more often affordable price points, to some of these higher end prestige items. The other thing that they have that's a bit different about how they operate is they have these in-store salons where you can go get beauty and hair care services in store at many of their locations. And obviously they also have Ulta.com and their mobile apps that provide a digital experience. So nowadays they have a real omni-channel option of their own stores, locations that have grown through partnerships with these major retailers like Target, and then their e-commerce stores. So what are some of the issues that the company is dealing with right now? Well, for one, there is increased competition in the beauty market. You have these newer companies like e.l.f. that have been able to be extremely competitive, offer quality products at a much lower price point per product on average, and are also catering, I think, to a new wave of shoppers and consumers. That's just one example. There's also been some spending in the overall beauty category slowdown in that area that I think has impacted businesses like Ulta. Although again, as we've seen, you've got some of these newer companies like e.l.f. that are continuing to do really well at retaining consumer dollars. They have had a really difficult time with normalization of demand for some of their products post-pandemic. They've been dealing with issues from inflation like a lot of other retailers. But honestly, the competitive landscape where you have a lot of these newer beauty brands targeting a completely different generation of shoppers, with Gen Z and beyond, where you've got consumers that their beauty habits are driven by TikTok and some of these other social media campaigns and landscapes. And that's been something that I think Ulta has struggled to maintain competitive in. Now, a couple things I like about the business. They have a really extensive loyalty program. Most of their sales come from loyalty members, and they've actually seen through the years a lot of data that shows that their loyalty members really like to shop in store as well as online. So there is a demand for their retail presence that they continue to have. For me, this is a business that I look at. I like the underlying business. I think that there is still a fair consumer need for something like what Ulta Beauty offers. The concern that I have is, as you have the e.l.f.s of the world and other types of newer beauty brands that are up and coming that are taking some of Ulta Beauty's market share, how are they going to remain competitive in that landscape? And I think that that's something that they're working to figure out right now. 95% of their total sales come from their loyalty members. So they do have a really extensive network of loyal shoppers that go into the Ulta stores and that shop, online through their digital channels. So I think that's something to be aware of. For me, if I was looking at this for my portfolio, I probably wouldn't want to take a major position in this company, just given some of the headwinds that I mentioned. But I do think it has potential to grow and remain a mainstay within, the beauty space moving forward. Again, it's worth noting, just to kind of compare to a newer company like e.l.f. again, Ulta Beauty has a lot of high operating costs from its network of retail stores. e.l.f. doesn't own their own stores anymore. They distribute through retail partners and through various e-commerce sites. Ulta is a primarily domestic venture. I actually don't think they have any locations outside of the US. e.l.f. does. Sephora is another major competitor you could think of that's, broad international footprint. So these are some of the issues that a company like Ulta is dealing with, and that they need to, I think, find a way to overcome to really, I think, usher in more meaningful growth for the business. And then the only other comment that I also wanted to hit right now was from Berlin Simon. He was saying guidance in groceries and restaurants seemed lower. does this point to macro recessionary pressures? I know, Danny, you and I both follow quite a few restaurant stocks. I think it really depends on the business, right? There's some companies that have done incredibly well. You think of the likes of, Chipotle, obviously, is one we talk about. Brinker International, they own Chili's and Maggiano's. Sweetgreen is one that's been really experiencing robust financial growth. And obviously the stock has done incredibly well. Kava is another one, Dutch Bros. So in terms of guidance, some of these businesses, I think, are moderating their guidance. But even if you look at the example of a company like Chipotle, they forecast guidance for 2025 of low to mid-single digit comparable restaurant sales growth. Their comparable restaurant sales increased about 7% in 2024 anyway. So that would be fairly in line with their growth the prior year. So I think it really depends on the business. You're also, when you're looking at restaurant stocks, grocery stocks, while it depends on what the individual business is, just overall, these are companies that tend to have, I think, much lower margins than companies operating in other sectors. And so they are very, likely to experience shifts in consumer spending. We think of, I haven't had time to delve into their report fully today, but I know Walmart, for example, reported their earnings and is forecasting a real moderate pace of growth in the new year. And I think some of that goes down to shifting habits of consumers, especially right now, I think, as there's some concern about the pace of inflation. But over the long term, I think quality businesses that have really great positions within their respective markets, like Chipotle, is again a great example, are going to be well positioned to win, over the next 5, 6, 7, 8 years, regardless of what happens in the next 9 to 12 months. What are your thoughts on that, Danny?
Or the next, couple of weeks.
Or the next couple of weeks. Yeah, the news has been moving fast recently.
I don't necessarily think there's macro recessionary pressures. Looking ahead, I would say there has been inflationary pressure that has been weighing on grocery stores and restaurants for the past couple of years. I mean, inflation, even though it has moderated, we're still, we've come down a little bit. We're still near historical highs. And that is going to weigh on margins, because restaurants are in a tough spot where they have to decide, are we going to increase prices to keep pace with inflation and risk alienating our customers, or are we going to take the short-term hit financially, not raising prices, hit the financials, but keep the customers coming in? And that's a fine line for a lot of restaurants. And I think that's one that many restaurants are still dealing with. We don't know when inflation is going to subside back to what I would call historical norms. But we still have some time to go before that happens. There was one question here that, or actually a comment I wanted to address. This came from Aaron with no bush, referring, of course, to Aaron Bush, one of our longtime favorite fools. Says, "Good morning, fools. Good morning, Fooldom. Have a great Celsius earnings day, everyone." Now, the reason I wanted to address this is because Celsius dropped a press release a couple of days ago that said, hey, we're going to announce our earnings after the market close on Thursday, and we're going to participate in an analyst conference on Friday. And the stock shot up following this press release, which was really odd. But normally companies like Celsius will provide a much longer window from the time they drop the press release until the time their earnings release takes place. And so that got some investors thinking that the company was going to release some good news. Now, to be fair, we don't know what they're going to say yet. It could be really good news. It could be bad news. It could be they just wanted to release their earnings so that they could participate in this investor presentation. So I just thought it was really interesting. I took a quick look. It looks like analysts are expecting revenue of about 327 million and earnings per share of about a penny. So Celsius has been hit hard over the past year because they were lapping the anniversary of their agreement with PepsiCo, and the distribution agreement basically had an outsized impact on the movement of their energy drinks for a period of time while PepsiCo got stocked up and got their distribution channels stocked up with these energy drinks. And then once they got past that anniversary and things fell off a bit, the stock took a hit. So I'm pretty excited to see what happens with Celsius. It may be that they've finally gotten beyond those tough comps and have something good to announce. But I'm pretty interested to see what happens when they announce, and that'll be after the market close today.
There was a question that had come in from Marley 41 minutes ago. Any thoughts on Castle Bio or BioMarin as investments? So I don't really follow Castle Bio very closely, although I'm going to look into that a bit after the show because I always love learning about these new companies and maybe being able to talk about them a bit better. But BioMarin is one I do follow. So I'm happy to offer my thoughts on that one. So BioMarin, they're a biotech company. They primarily develop and sell therapies for various rare genetic disorders. So they focus on rare diseases primarily. I believe currently they have 8 different approved products. And they also have a broad and extensive growing pipeline. And so they're focusing on, enzyme therapies, gene therapies as well. One of the gene therapies is a treatment for hemophilia A. This is a company that has really been faithfully growing their revenues and is also profitable, which is something I really like to see in some of these biotech companies that don't have that many products commercialized yet. And so you're not always necessarily seeing that kind of a growth story yet. And so that's something that I think is worth noting. They have a few different products that are, I think, really major drivers of growth at this point. And I wanted to highlight a few of those. One is a drug called Voxzogo, and BioMarin has said that they believe that this drug will be a $5 billion market opportunity. Voxzogo is essentially a medicine that treats a condition called achondroplasia in patients age 4 months and older whose bones are still growing. And so this is what this is approved for, a multi-billion-dollar market opportunity, but they are also working on getting it approved for other indications and other rare disorders into the late 2020s and early 2030s. They have a couple other blockbuster drugs in their portfolio as well. Both of these treat very rare, underserved diseases. Actually, they just reported their financial results for 2024 yesterday. So I wanted to go through those just really quick and give kind of a few updates about the company. So in Q4, their revenue was $747 million. That was an increase of 16% year over year. And again, Voxzogo, which was that top blockbuster drug that I mentioned, was a key driver of their growth there, but also their enzyme therapies. Growth from their enzyme therapies was 9% year over year, compared to the fourth quarter of 2023. GAAP net income, again, as I mentioned, this is a profitable business, right? So they reported net income of about $105 million in the fourth quarter of the year. Now, looking at their full year 2024 highlights, they reported total revenue of $2.85 billion for 2024. That was up 18% year over year. On a constant currency basis, it was up 22% year over year. Now, they have a a number of, I think, really promising candidates in their pipeline currently. And that includes a drug targeting Duchenne muscular dystrophy, as well as a drug candidate for multiple musculoskeletal conditions. They're also expecting a major phase 3 study for an upcoming drug candidate called Palantir. I'm not sure how to say it. It's as always, these medicine names are very difficult to pronounce, but essentially it's treats adolescents. They're studying with several types of very rare diseases between the ages of 12 and 17. So a number of studies to be watching. Again, as I mentioned, they have a relatively small portfolio of drugs right now. Voxzogo is one of their biggest growth drivers, as are some of their other enzyme therapies. They are also looking again to get this drug approved for other indications in the coming years. And that condition, achondroplasia, that I mentioned that their key drug, Voxzogo, treats, Voxzogo is actually the only treatment for this condition. And it has shown significant improvement for the cohort of patients that it treats, which again is as young as children of 4 months of age. So this is a business that I like. I think that there is a lot of potential for this company moving forward. Just that top drug I mentioned, Voxzogo, saw 56% year-over-year revenue growth in 2024. They are working to expand the rollout of that drug globally. And it's worth noting that the condition that drug treats, again, that's called achondroplasia. Management at BioMarin thinks that the U.S. is the largest single market opportunity for this potential drug. So the launch momentum that they are on right now is tremendous. And they think that this is going to be a real key driver of their growth moving forward. But also, as I mentioned, their enzyme therapies are continuing to help deliver strong revenue growth and profitability. So I like this company. This is one of the types of companies I talk about where you're looking at a smaller biotech. It isn't as well known as some of these other big companies we talk about, but they already have a nice portfolio of market leading products that are targeting underserved or diseases that have virtually no medicinal options. They are facing broad addressable markets for each of these products. They're growing revenue at a really healthy pace, and they're profitable. So that's something I like to see in a biotech business like this. And so this is one that I really like. And I wanted to give a quick update on how they performed in 2024. So this is one that I'm excited to see what they deliver in the Q1 of 2025 and moving forward into the year.
And that's a nice segue. Speaking of a company that I really like, we've got a couple of questions in the queue about MercadoLibre, ticker MELI. Sadaf said, I'm borderline scared for Melli earnings today. And Steve Mitchell says, ditto on Melli. This is a time to hold great businesses and ignore these temporary freakouts from quarters and tweets. And I think that's a great. I think that's a great way to look at it. I actually took a quick look at what's going on. MercadoLibre is supposed to be reporting after the market closed today. I looked at expectations. Wall Street is expecting revenue of $5.94 billion and earnings per share of $7.56. Now, I bring that up because I want to try to share a screen again here and see if I'm a little bit more successful than I was earlier. So I'm going to try to bring up MercadoLibre's chart here from over the past year or so. And what this chart shows is that around each one of those little purple circles that you see is the company's earnings date. And as you can see right here, you have an earnings date and then you have a precipitous drop off. You have an earnings date and then the stock climbs. You have an earnings date and the stock soars. You have an earnings date and the stock drops like a rock and then recovers. So the reason that I share that is because MercadoLibre is a company that I've covered since 2009. And it has historically been very volatile around earnings. And so very much to Mitchell's point, yes, this is a great business. Just to give you for investors who may not be familiar with MercadoLibre, MercadoLibre is a company that is a leading provider of e-commerce services, an e-commerce platform, and also digital payment methods in Latin America. And the company does a remarkable job of consistently delivering results that are really solid. Now, because the company operates in 19 different or 18 different Latin American countries, and it is listed on the U.S. stock exchange, it reports its results in dollars. However, it earns those results in the currencies of the 18 different countries in which it does business. So, for instance, in the quarter that ended September, they generated net income of $5.3 billion. That was up 35% year over year in US dollars. But if you look at it in terms of the local currencies, that was an increase of 103%. It's really tough for some investors to look at 103% and reconcile that to 35% revenue growth in dollars. But that's the nature of the beast with foreign currency translation. And that's part of the reason why MercadoLibre stock has historically been so volatile. So I am right there with you. MercadoLibre is one of my top 5 positions. It changes based on the day. I think most recently I checked, it was my number 3 position. And I expect it will be volatile after earnings today. Will it go up? Will it go down? I have no idea. But no matter what the stock price does in after hours trading or in the days that follow, I'm not planning on selling my MercadoLibre shares.
Yeah, that's a business we've talked about a lot. I like that one. Let It Ride was asking about a bunch of healthcare tickers, asking for ranking them. Eli Lilly, Pfizer, AbbVie, Novo Cure, and Amgen. For me, it's as I'm looking at these, if I'm looking at it for my portfolio, I own shares of Eli Lilly and AbbVie. I've stayed away from Novocure at this point, although I think the business has a lot of promise. So maybe I'll talk briefly about kind of my thesis for each of these. Amgen, I'm not a shareholder of. Eli Lilly is probably the one I would rank top on that list for myself as someone that already owns shares and would like to invest in more. And not just because it's been a kind of banner year and a half, 2 years for the business with the GLP-1 boom. Their drugs, Mounjaro and Zepbound, have been a huge driver of growth recently, as they have been very formidable competitors to Novo Nordisk's Ozempic and Wegovy. And they saw their revenue in Q4 2024 increase 45% year over year with the incorporation of these products. But this is a business that already has other well-known blockbusters on the market. Jardiance is another drug in the diabetes care space. Taltz, which is designed to treat a variety of ailments, including plaque psoriasis. They have other top-selling drugs like Trulicity. Verzenio, which is an oncology drug designed to treat patients with metastatic breast cancer. This is a company that is one of the oldest pharma companies in existence still. They are in incredible financial shape, and they already have a lot of other robust blockbuster products in addition to these GLP-1 drugs that have continued to be really strong drivers of growth for the business. Something else that they started doing recently that I really found interesting, and this is also a similar rollout as Pfizer has also done, is they launched a direct-to-consumer platform. which is not a model that you've seen as much with some of the pharmaceutical companies. But I think in the day and age of companies like Hims and Hers Health, some of these pharmaceutical companies are looking at ways to stay competitive. So there are certain specific products that you can go on Eli Lilly's, direct to consumer platform and purchase straight from them, which I think is also kind of an interesting initiative that they've launched. So Eli Lilly would be my top pick. I think Pfizer would probably be the second one for me. I've talked about this company a lot. I think that they're in a really unique transition period right now, but all that money that they brought in from these, years of COVID growth from their COVID-19 products, they've put to exceptional use with acquisitions and rolling out a series of new products. Their R&D as well as M&A activity over the last 3 years, I think, is going to be really integral to where you see the company growing over the next 5 to 10 years. They already had estimated that some of these business deals would add about $25 billion in risk-adjusted revenues to their top line by the early 2030s, which is notable not just because they are dealing with a normalization of growth post-pandemic, but also because they're dealing with increased competition in the generics market for some of their older drugs, which I think is something that's worth noting. But they had a pretty good year in 2024. Even if you exclude their COVID-19 products, revenue still grew 12% year over year, which is much higher growth rate than its pre-pandemic growth rate. AbbVie for myself is probably the one that I'd put a number 3 on the list. I mentioned I'm a shareholder in this company. They have a couple really notable top-selling blockbuster drugs. One is called Skyrizi, another is called Rinvoq. For a long time, they were known for their drug Humira, which at one point was the world's top-selling drug. Humira's faced increased competition from the generics market the last few years, so that has become a less reliable source of growth for AbbVie, but still a strong contender in its portfolio. And again, AbbVie is also the owner of Botox Cosmetic and Botox Therapeutic. I think the one that for me I would rank last of the 4 companies I mentioned that I'm watching from afar, but I'm not yet taking a position in, is NovoCure. Again, they're known for their tumor treating fields technology. They're working on commercializing this therapy, which could be incredibly innovative. Still the very early stages of growth for the business. They are increasing their US approval rates. They're also launching in core international markets. France was one of their recent launch regions. They're still not profitable. And so this is one that I'm currently watching to see some improvement, more improvement with the bottom line before I would consider a position.
So there's a question in the queue from Jimbo has a question. And it says, Wing, ticker WING, has been down for the last 2 quarterly reports. The revenue did not meet expectations on the last one. Should we review the thesis for holding this stock? I don't own Wing, and I'm not that familiar with the business. However, there were a couple of things in this question that kind of struck a nerve with me, struck a chord with me. So I wanted to address those. Now, the first is we're talking about Wing stock being down, the stock price being down after the last 2 quarterly reports. So we're talking about 6 months. Now, the first thing that brings up for me is, I don't know about you, Rachel, but when I'm looking at an investment of mine, I generally tend to hold it for a minimum of 3 to 5 years. So if I see, excuse me, if I see 2 questionable quarterly reports in a row, that's really not changing my investing thesis because the stock is volatile, or because revenue did not, and this is the second part, revenue did not meet expectations for Wall Street. To me, that just means Wall Street didn't do its models right. The other thing that I wanted to bring up about this is, it's important for investors to reconcile the definitions of volatility and risk. Volatility is how much the stock moves up or down in a given period. Risk is the potential for the permanent loss of capital. In other words, the potential for your stock investment to go to zero versus just going up or down. So I would say, just from my point of view, I'm not going to make any decisions on any stock based on 2 quarters. And secondly, let's make sure that we distinguish between risk and volatility. And finally, I guess it depends on what your investing thesis was in the first place. If your investing thesis was whether or not the stock was going to go up or down, you might want to revisit that.
Thanks for that, Danny. With that, it looks like we are actually up against time into the new hour. I know up next, Toby and Matt will be leading the way. Hey, guys.
Matt.
Hey, Danny, you look a lot warmer than I am. It's snowing here.
It's actually supposed to hit 72 in San Diego today.
I moved to South Carolina to escape the snow, and now,
and now it's following you.
Third time this year.
You got to wonder if it's the weather, Matt, or is it you?
It's because I don't have my Hawaiian shirts out. I have a bunch of them.
Danny's keeping the good weather.
See, last time I wore one on Fool Live, someone asked if I was trying to be Danny Vena. So that's why I can't do it. It's not my style. So
fair enough.
Thanks, guys.
We will leave you to it. Fool on, guys.
Hey, Toby.
Hey, how you doing?
Good. It is the fun. I call it the fun part of earnings season. It's like when all the smaller, more volatile companies start to report. It's always one of my favorite times of year. Even though it's snowing, it's a good time for me. Hopefully, you've been enjoying earnings season a little bit as well.
I have been. It's been exciting. A lot happening with our companies. Some fairly dramatic movements with some of them post earnings, Matt, which is, I don't want to say fun because it kind of depends on the direction that movement is heading in as to whether it's fun or not. But it's been a lot to follow in some cases.
Yeah, I feel like a lot of the stocks that seem to have been able to go nowhere but down in like the past 2 years are now starting to actually get some life after earnings. One of the companies I own, Appian, reported yesterday, and they were up like 20%. And it seems like they could do no right over the past couple of years, so that was really refreshing. But then it seems like some companies that could do nothing but go up reported and then went down. It's been an interesting quarter, and we have some exciting ones today.
We do.
We're going to talk about fintech earnings.
Yeah. So that's our focus, guys. Earnings on fintech companies. But as always, if you have an exciting company that is or soon to report has or recently or is soon to be reporting earnings that doesn't necessarily fall into fintech, feel free to throw that in. We'll see what we can do about it. But this is your chance to really get your answers on the fintechs this hour. So hit us up with your questions in Slido at Slido.com. Fool24 is our event code. So head there if you're not there already and let us know what you want us to think about and talk about this hour.
Yeah, I feel like fintech's finally starting to become cool again. For a while it wasn't. After fintech had a really big boom during the initial pandemic phases, and then when things started to calm down, a lot of the growth just kind of had been so pulled forward. Like think of a company like PayPal that it just kind of totally stagnated, and now it's starting. We're starting to see growth again. We're starting to see exciting times again. Square changed its name to Block and is now XYZ. So name changes are happening again, and last time a bunch of companies started changing their names, it got very exciting in the market. So I'm going to go ahead and share my screen just for a minute and talk about some of the ones that have already reported and some that are yet to report. It's actually an exciting earnings day. We're going to get some exciting earnings in the next hour or so. So hopefully you guys can see this. Nope. Can you guys see this okay? You'll see this in a minute.
Yeah, I think it's coming up in a second.
There we go. All right. So a bunch of companies, this is not an exhaustive list, by the way, just some of the major fintechs that have reported and are yet to report. Visa and MasterCard both were toward the beginning of earnings season. PayPal has already reported. Upstart, one of my favorite companies to talk to, and now for a good reason, has already reported. Shift4 is one that's also on my radar, ticker symbol FOUR. And companies that are yet to report, all three of these report today after the close. XYZ, which always confuses people because it was Square, then it became Block, but was still XSQ. Now it's still Block, but now the ticker is XYZ. And just to confuse you even more, the small business part of the company is still called Square. So yeah, really confusing business, but a lot of fun to follow. MercadoLibre, I know Danny just talked about MercadoLibre in the last hour.
Mhm.
They report today, and the last quarter was kind of interesting. New and You is a company that I am not that familiar with, other than it's a Warren Buffett stock, and he just sold a bunch of it. It's the Brazilian fintech. I don't know the business that well. Um, but all three of those report today. Just to kind of quickly recap, and we can talk about these a little bit. And Toby, please stop me if you follow any of these really closely and want to dive in. Visa and Mastercard are both boring in the best ways. Their earnings continuously seem to grow by 12 to 15% a year. Um, the stocks continue to slightly outperform the market over time. Visa's up about 10% since earnings. Both companies beat expectations on the top and bottom lines. What can we say about Visa and MasterCard other than they're just predictably great businesses? I don't even know if we consider them fintechs at this point. They're just such established tech companies.
Yeah, I mean they're not in that, I think, the same space that people would normally use fintech to describe. I think they are, but when you say fintech, you a lot of people think smaller startup financial company that is trying to attack MasterCard and Visa, right? They're like the standard in which everyone else is trying to go after.
Right, but by a lot of definitions, I would even call PayPal like a borderline fintech. It's just so big and established. I mean, who doesn't have either PayPal or Venmo? I mean, I'm not sure I've met an American adult that doesn't have either one of them in the past couple of years. But as far as the results, PayPal is one of the ones I was talking about that really just stagnated after COVID. They brought in a whole new management team, completely overhauled the C-suite. Decent results so far. The focus so far has been on efficiency. You can see revenue was up 7%, but earnings per share was up 21%. That's a great indicator of efficiency in the business. Active accounts still aren't really growing, up 2% year over year. But there's a lot that they've done that is not in the results yet. The big ad platform they were going to launch didn't go live till mid-October. So it's just starting to ramp up. They took Uber's head of advertising to run that. So impressive results from PayPal. Oh no, Toby, are you a shareholder in PayPal or Visa or MasterCard or any of those that we've talked about so far?
I hesitate on PayPal because I'm not 100% sure. Let me look. It may be in one of my kids' accounts. On Visa and MasterCard, I am not. I used to be. MasterCard, I ended up selling off to put the money elsewhere. It was a great business while I owned it, and it has continued to be a great business.
Upstart is one that's really, if you talk about a stock that's been on a roller coaster ride, since it went public in, I think, late 2020. Mm-hmm. Upstart, UPST, it went public, went soaring out of the gate, went up to about $400 a share, went crashing back down. I think it bottomed at like $12. I remember at one point it was down 97% or so from the highs in 2022 or 2023, and now it's starting to find some new life. I mean, it's easy to say why Upstart was doing so well back in 2021. Access to money was essentially free, so they can get all the capital they wanted. I think at one point they issued convertible bonds with like a 0.25% interest rate. Money was free, and lending demand was off the charts because interest rates were so low. You can get a personal loan for like 5% at the time. So that really dried up. The business kind of crashed, and they had to put their growth on pause. But look at some of these numbers. It looks like Upstart's business is actually stronger than it was at that peak. That fifth bullet point there, they're expecting their first $1 billion year ever in 2025. They never had a $1 billion revenue year, even in the booming times. They're expecting GAAP profitability for the first time since 2021. And they're starting to, this was on this was part of their growth plan for forever, but they're finally launching auto loans and home equity lines of credit, and they're growing really fast. And those are massive markets. Upstarts, they're up. The stock is up. You can see 244% since July.
Yeah, it's been a little bit of a run here.
It is.
This is the one I do own, Matt. Now I bought it. I think I didn't ride it all the way down, but you would arguably say I bought too early as it was coming down. But I do own this one, and it's been nice to see. And I like big round numbers, right? So whenever I see a smaller company cross that for $1 billion threshold, that's something to cheer. I also I did look up. I am a shareholder of PayPal. Well, I am not. It's actually my wife's IRA, so that's where I was thinking of it.
You have to count your wife's stocks too.
You got to, yeah, you do. And I think in her case, it comes from I think she's holding the shares from the eBay spinoff.
Yeah, like my wife owns Etsy and I don't, and she bought it, when it was $6 a share a long time ago, and now gets to claim the title of the best stock picker in the house.
Yeah, there you go.
All that fun stuff. But so that's Upstart, really interesting business model, and essentially has a string of 3 great quarterly reports in a row is why it's up so much. So let's talk about some of the ones that are going to report today. MercadoLibre is one of them. Just kind of to recap what happened last quarter, and I think this is why a lot of investors are nervous about it. The stock dropped 11% the day after earnings. Profit margins were under pressure. Growth looked fine. I could pretty much tell, I mean, I don't have a crystal ball. I can tell you it was the holiday quarter. The sales numbers are going to be fantastic. The profit margins are going to be the part of this report to really watch. And it's not just that the profits didn't meet expectations. If you look at that second bullet right there, MercadoLibre's management said it was due to growth investments, but out of that 740 basis points of margin compression, 340 were due to, quote, bad debts. And as they ramp up the credit business, that's a concern. So that's what I'll be watching when MercadoLibre. So pretty much everyone that I know, all my friends at the Motley Fool own MercadoLibre. Do you, Toby?
No.
Oh, no. You're the one.
Yeah. Wait, no. Okay, hold up. Now I have to go check my wife's IRA again because it's just one that I felt like for the longest time, because I'm a relatively new shareholder. It was a COVID purchase for me. For the longest time, I felt like I was the only one who didn't own MercadoLibre out of the foolish crew. But it's one I've always looked at, and I just never have gotten around to it.
Yeah, it's one that was really easy to miss in the early days. I totally missed the boat on that in the early days and took advantage of the initial COVID plunge to become a shareholder. This is one that I've owned for a long time. I owned Square back when it was called Square, and back when the company's entire business were those little Square card readers that were in people's iPhones. I bought Square. I bought the company, I think, 2 days after the IPO.
Oh, wow.
Yeah, like a long time ago. Mixed results in the third quarter. The company, if I have to be totally honest, they lost their focus for a while. The acquisition of Afterpay, they totally overpaid for that. The acquisition of Tidal, I'm not sure why they made that. It didn't. I still don't really understand where it fits in their business. And all the different blockchain. I'm a big believer in blockchain technology, but all the different directions they were going in that just kind of seemed like they lost focus. And Jack Dorsey, last year's shareholder letter, the first phrase was, "We've been quiet because we've been focused." So they have refocused into just the core Cash App and Square small business ecosystems. Both are growing really fast. Just like MercadoLibre, profitability was the issue in the third quarter, and it dropped 9% after the report, but still way off the lows. Business is doing well. I'm happy with how they're doing, but that's always a fun one to watch. And Jack Dorsey shareholder letters are always fun to read. And I think those are all the ones I had on there. Let me go ahead and stop sharing. Toby, what fintechs are you looking at?
Well, I do. Let me make a couple of points from questions. Right, I can answer your question as I'm looking at a couple of questions here. I know we did. So we did have a question from Jimbo on Sezzle. Is that one you've looked at closely, Matt?
Not really. That's one I've been meaning to dive into.
It's a new one. I haven't looked at it close to get either. I wanted to mention that and point that out because we are planning on bringing you an interview with the Sezzle CEO next week on Fool24. Tom Gardner and Andy Cross are going to be doing that. That is on, help me out with my days of the week here, Matt. I think that's on Tuesday, the 25th of February. So look for that.
Sounds right.
Your questions on Sezzle, I say bring him to that. That'll be a very good opportunity to hear from the CEO. So that's on the plans for next week. The other one I see questions on Grab. This is the company I like. It's one I follow a decent amount. The specific question here is on does Grab has a? I see from Jimbo, does Grab have a fintech division like Melly's, Mercado, Pago? And I thought I saw another question down here on Grab as well, but I know it definitely comes from Jimbo here. And Seda 5 minutes ago. I am also curious about Grab's buy now, pay later business. I would appreciate if you can talk about it as well. So they do, Matt. They do have a very robust fintech business. Several products Grab has. Grab Pay, because you have to have a payment app, right? You got to have a payment app. Grab Pay is a mobile wallet. It's you can do purchases for Grab. You can do peer-to-peer transfers similar to PayPal, similar to Venmo. So that's their payment app there. They have a business called Grab Finance. This is really geared toward their not a consumer thing, right? So what this is for is it provides for their drivers, for the merchants on their platform, for other things, financial services for those companies. Things like maybe you need a loan for your car, you need a bank account or whatever, right? That's geared toward more of their non-consumer partners on their platform. Grab Insure is an insurance business, so it's a financial insurance product that they offer as well. I believe that was originally started because they had drivers who didn't have car insurance or motor or cycle insurance, what have you, right, for their vehicle they were using for delivery. And so they said, let's solve that problem by starting an insurance business on our own. And they have built that since that initial kind of step there. And then they have, I don't know, would you consider, they do have a rewards program. I don't know if I consider that fintech, but it's fintech adjacent, I guess you might say, on their platform. But so they do have several businesses that are squarely in the financial space that they operate. They also do, they have a bank, I think, that they launched in just one area, not all the geographies, in Singapore, an actual whole bank there, GXX is what that's called. So that's out there as well. So they're definitely in the space, much like you would expect from a super app type business here.
And I see a lot of questions about Upstart, so I'm going to try to combine them.
All right.
Matt says, Mr. Frankel, when you and Jason did that first scoreboard episode about Upstart, did you make the point that the company was or is scaling very poorly? I don't think what I meant, that was the quarter when Upstart plunged because they revealed that they were holding a lot more loans on their balance sheet than they wanted to. The goal of Upstart is to sell their loans to investors, and that wasn't happening as much as they would like. Let me see the other ones. Totally lost my place. Toby, if you want to grab something real quick.
Let me look for him too.
Hold on. Here you go. What are your thoughts? Go ahead.
Yeah, we just have some general questions. What are your thoughts on Upstart from R2D2? Yeah. And then Steve Mitchell, Upstart prognosis, right? So
I think those came in before the slideshow we just did, but I want to add something. As far as my thoughts on Upstart, one of the most interesting thing in the fourth quarter earnings report was what's happening with their two newer loan verticals. Personal loans still make up about 98% at least of Upstart's loan volume. It was about 2.04 billion out of 2.1 billion of loan volume was personal loans, by far their biggest part. They launched auto lending a few years ago, but never really ramped it up, and that was up about 60% sequentially, like quarter over quarter, in terms of the auto loan volume. So that's starting to get a little bit of traction. And auto lending, the market size for auto loans is roughly 4 times the personal loan market. So that makes up way under 1% of Upstart's loan volume today, but is growing very fast. The part that's really interesting to me is home equity lines of credit, HELOCs. Upstart just launched those at the end of 2023 and is ramping it up. It's still a very small percentage of their loans. It's about 1% of their, or less than 1% of their loan volume. But that also grew over 50% sequentially, just from the third quarter. And one really interesting thing, that growth is at a time when mortgage rates are terrible and very few people want to get home equity lines of credit. They're still ramping it up like that. And number two, right now, American homeowners have a total of about $35 trillion of home equity, the highest in history. And if interest rates start to come down and normalize, people are going to start tapping into that. Remember the volume with which people were tapping into home equity in like 2021, when you could get when you could refinance at 2.8% or whatever it was. So that those two verticals are what I see as, if they can scale it, then there's a very, very bright future for this business.
I think so. I remember what are we in 25? Let's call it a year and a half ago now, when we were buying the house we were in now, and moving. Part of the financing package for that was a HELOC portion, because we were kind of doing we were using it as like a bridge loan to bridge the difference between moving out and moving in, right? And I remember my mortgage broker saying it's a little bit challenging because a lot of people who used to do HELOCs aren't doing them anymore. They're just moving out of the space. They don't want to do it. And I think Upstart is getting into this right at a nice time, at one, when you're seeing some other players exit the business, they're coming in and saying, all right, we can offer some of these. And if you do see an interest rate drop and this starts to drive either refinancing or home purchase in general, I think they're coming in at about the right time, when this could be a significant growth story for them, depending on how things develop with the housing market.
Yeah, and I mean, remember, Upstart's whole business model is that they are better at underwriting loans than the FICO model. They do a better job of predicting defaults and things like that. And so with home equity lines of credit, the average home equity line of credit has an interest rate of closer to 10% today, not like the average 7% mortgage rate. And it's backed by a house. So it's a secured form of lending. The average interest rate is close to 10%. And if they can do a better job of underwriting and predicting defaults than the FICO model, that's a pretty good value proposition to sell to investors who buy loans from Upstart. So there could be a lot, and like you mentioned, a lot of companies have exited the space. So there are fewer home equity lines of credit on the market that companies could transfer and could take over. So I think that's really an area to watch. I think that'll be a make or break for Sofi, the auto loans and home equity lines of credit, or Sofi, Upstart.
Yeah,
you knew what I meant.
Yeah. Oh, yeah. Sure, I got you. Yeah.
Let me see. Are you familiar with the deal between Affirm and Shopify? I need to look into that. I see a question about that.
I'm not. Is this a new thing? Because I know, wasn't Affirm on Shopify before?
I know Shopify has deals with a lot of fintech companies. Let me see if I can. Yeah, it's an integration deal. Affirm is the buy now, pay later company. They're integrated with Shopify now. It says the integration gives you access to all of Affirm's features, so Shopify merchants can offer that to their customers. But it's also worth noting that PayPal just, in the third quarter of last year, formed a new deal with Shopify themselves. And now PayPal checkout is an option on Shopify. It used to just be in France. That was it was like kind of a trial partnership, I guess you would call it.
And so now it's everywhere.
And now it's rolled out, at least in the U.S. I don't know if it's totally everywhere, but it's at least in the U.S., which is, that's where you want it. So a lot of companies have integrations with Shopify. Shopify's goal is to offer merchants as many different options as possible to pass along to their customers. So as long as PayPal keeps forming relationships like that of its own, then I'm happy with it. PayPal's had a lot of success with partnerships with their new products called Fastlane Checkout. I'm not sure how familiar you are with that. The goal of that is to cut down the checkout time on websites. And it's such a good job that companies that you would think of as PayPal rivals are partnering with them to offer this to customers. Adyen is one of them. Adyen's a pretty big PayPal rival. When eBay ditched PayPal, it was in favor of Adyen, and now the two are partnering to offer PayPal checkout to Adyen customers. So, if they keep having traction like that with partnership deals, then I'm happy with the progress. There's like I said in the slideshow, there's a lot going on with PayPal that they did in the third or fourth quarter of last year that are not reflected in the numbers yet. I love the advertising platform and think it has a ton of potential. And they announced it, I want to say in May of last year, but a lot of people don't realize it didn't actually launch until about mid-October. So that's something that, it's just not reflected in the numbers yet. The Shopify partnership launched late. It's not reflected in the numbers yet. So there's Affirm is a very impressive business, by the way. They outperformed my expectations in terms of loan defaults and things like that. When the buy now pay later craze was happening in 2021ish, you and I did a show where we said it was going to end badly.
Yeah, I did not expect it to go well for them. They've surprised me.
Yeah, they've performed really well. So I nothing but respect for Affirm, but PayPal's, I don't view them as a direct threat.
Now, in our defense, Matt, it did go very, very badly for them at the end of 2021, early 2022 in terms of stock price. After that whole buy now, pay later craze was, at its peak, and it just kind of, but they've been doing quite well since that bottom they had there a couple years ago.
It was the same reason that we saw, even bank stocks plunge at the time. Everyone said, interest rates are rising. All these consumers are going to default on all these obligations, and it really didn't materialize. Okay, Matt clarified. Mr. Frankel, you said that Upstart has gotten less profitable as the business has gotten bigger, which I took to meant that you thought they were scaling poorly. I don't want to say they were scaling poorly because the business was getting bigger, but the environment was eroding at the time. Interest rates were rising. Money was just becoming more expensive, and investor interest in loans, which is a big part of Upstart's business model, that was kind of going away. So it's not that they were scaling poorly; it's that they were having trouble getting. They were scaling too fast. If anything, they were having trouble getting the loans off their balance sheet. A company like Upstart does not want to hold, billions of dollars of loans on their balance sheet. That's not the goal. They want to be a third party, originate the loan and sell it to an investor. So I think that I'll have to go back and see what I exactly I said at the time. But I remember that pretty well. I thought the business they were making the best of a bad situation. But they were having to keep a lot more loans on their balance sheet, which maybe I could have, that could be taken as scaling poorly.
Yeah. Let me make one clarification here, Matt, on the Sezzle interview we've got coming up. It looks like that's actually going to be a recorded interview that'll air a little bit later on Fool24. I think there was some scheduling quirks to work through with that. But so it's not going to be, as of now, not going to be live. It'll be recorded and we'll show it on Fool24. But still look for that, right? Still look for that interview coming up on, whatever you guys want to. You should get your fill of Sezzle between Tom and the CEO and Andy Cross there.
I'm so happy to see a lot of these interviews coming back. That was
I think it's good. I think it's good we're able to offer these to our members.
The early days of Fool Live, that was one of my favorite parts, and probably the part that I learned the most from was having business experts on the show. And I mean, I talked to a lot of really interesting. I had some of the Shark Tank guys on, and they were always fun to talk to.
Nice.
And so I'm really happy to see interviews coming back. Let's see.
Nice.
Vihan's asking a loaded question there. Matt, PayPal versus Adyen versus Sofi versus O, which is Realty Income. Which look attractive at the current valuation? Yes. I think all of those. The only one I don't own on that list is Adyen, just because I prefer PayPal in that space. I think PayPal is a very attractive stock at the current valuation. I believe, and don't totally quote me on this because the numbers are not right in front of me. I think it's like 16 or 17 times forward earnings, despite having a big net cash position on the balance sheet. Highly profitable company. They're pretty much spending everything they're making on buybacks, and not just to get rid of stock-based compensation. I know I'm normally the stock-based compensation police, but it's not just for that. It's that they really think that their stock is undervalued. I think that could be a extremely cheap stock if management can deliver. SoFi is not a cheap stock. I can tell you that right now. It is not a cheap stock. If you look at pretty much any metric that's normally used to value a bank, which SoFi is a bank, like price to book value, tangible book, and things like that, they are not a cheap bank stock. I still think it's an attractive business. They're growing very fast. And profitability is scaling up very rapidly, but it's not a cheap stock. And Realty Income is the other one that was asked about.
Yeah.
That's the business has improved over the past, say, 3 years. Their earnings are up. The business continues to grow. They're doing well, but meanwhile, the stock has underperformed the market dramatically. And the reason is interest rates. Real estate investment trusts have underperformed because of interest rates, for the most part. Some of the businesses are hurting, but not in this case. Occupancy is great. Rental income continues to steadily climb. They keep finding new ways to invest. They just formed a data center partnership with Digital Realty Trust. Realty Income and PayPal are the two on that list that I have bought in 2025. So hopefully that answered the question well.
There's a question here from T-Stock from 12 minutes ago, who asked, what are your thoughts on the app-based brokerages like Robinhood versus the likes of Schwab and Fidelity? This is an interesting question, Matt. Robinhood relatively new to the game in terms of brokerages. When did they go public? That was right after COVID, right? Was that 2020, 2021?
Yeah, they're recently public. Actually recently,
very recently public. And they had that whole, we all remember the good old days, right? Right after COVID, when we were sitting in our houses, not doing anything, trading stocks, and Robinhood was right in there with the whole memeing of various fund stocks that perhaps some people bought and rode all the way up, and hopefully did not ride all the way back down. But legit, they're legit broker now, right? They do have a lot going on. Do you have any thoughts relative to the other ones?
Well, in terms of using them as a broker, or in terms of their stocks?
I guess those are two
different questions.
Have you used them as a broker?
I have two brokerage. I have brokerage accounts at two different places. I have Schwab and I have SoFi. So I do have an app-based broker and a traditional broker. Okay. Robinhood, I will say, has done a fantastic job of pivoting its business. You mentioned the meme stock thing. Remember when they had to cut off traders because the GameStop,
right. So you can't, we're not allowing trades in this GameStop anymore. Right?
And because of all that, they were like, oh, you're gamifying investing, and now it's going to hurt your business. They've really pivoted. They've focused on long-term investing. Robinhood offers IRAs now. They didn't used to do that. They offer, a lot of different retirement and subscription products and things like that. They offer stock research. Things like that long-term investors need. So they've done a really good job of pivoting.
And those retirement account assets are up, I think 7x in the past year. If you look at what they're doing, so that's been very popular for them.
Yeah.
So,
They've done a really good job of that. I mean, Schwab and Fidelity are just they are what they are. They're both enormous brokers. I think Schwab has something like $9 trillion of assets. It's something ridiculous like that.
Yeah.
They acquired TD Ameritrade, which itself acquired a few things over the years. So it really is like a combination of a bunch of brokers.
Yeah, Schwab is my primary broker, and I've been through multiple broker shifts via acquisition, and it's always been someone else acquired my broker, so I had to
Yep.
deal with all that nonsense. First I think it was TD Ameritrade bought E-Trade or something, and I had to shift, and then I had to shift even before that. Like there's an old Browning company, I don't remember them. They were bought by E-Trade, as I recall.
I want to say TD Ameritrade bought Scottrade.
Yeah, they bought Scottrade. I believe that's right. And then the Schwab acquisition which it was a couple of years ago, but it's been a slow transition.
It took a while.
Yeah.
But I had TD Ameritrade since 2003, back when it was just called Ameritrade. Before it was TD. And so I became a Schwab client by default. But pretty much all my new investments are going into SoFi. I don't like big banks. I just as a customer, like I love like Bank of America is one of my biggest investments. I love their management. I think they're doing a great job. I don't want 0.1% interest on my savings account. I want a very
2 or 3, right?
Right. I want to make interest on my savings account. I want my brokerage and my bank accounts in one place, and for one of them to not be bad. All the big banks have, like JP Morgan Chase has an investment platform. It's not as user friendly as some of the more app based ones. So I like having everything in one place, which is why I'm a SoFi person. Robinhood kind of has savings accounts, but not really. You can't get a checking account through Robinhood. So I don't know.
I feel like of those, the 3 that were mentioned by T Stock here, right? Like Robinhood, like if you're gonna look at these investments, right? I feel like Robinhood is the one you go to if you're looking for high growth and high potential, right? For sure, of those 3, no question there. Schwab and Fidelity have a whole lot more going on, right? Schwab's got a whole bank side to it. A much
Fidelity's private, isn't it?
I think Fidelity's private, right? I think that's right. Is it? I'm not 100% sure.
I believe Fidelity's still private.
I feel like I would have run across it if.
Yeah.
Schwab's investable. It's a much, I would say, more robust full service platform right now than Robinhood. There's more you can do on that. Not everyone wants or needs to do everything you can do at Schwab, so that might not be attractive depending on what you're looking for. Also, both Schwab and Fidelity have a lot more available in terms of financial planning and wealth management right now. Now, I think we should not be surprised to see Robinhood getting into that game, I think, at some point, right? Because there's a lot of money in that. And so I'm sure that's a direction that they certainly want to go in. But that is one of the strengths of both Schwab and Fidelity, the ability to, you have more, and they're targeting a higher net worth client with that, right? But you have more opportunity if you can say, look, we can offer you a range of financial planning. We can offer you some retirement planning. We can offer you wealth management services. We can offer you charitable donation tools. We can offer you the ability to borrow against your brokerage account if you're buying a house, right? Like there's all that wrapped together with that. But very, very different animals between those 2 and Robinhood for sure.
Yeah, I mean, if you want an easy place to occasionally buy and sell stocks, Robinhood's the one is the clear winner.
Yeah.
Schwab and Fidelity, their online platforms and mobile platforms are good, but they're not as easy as Robinhood.
No, and they're multiple different platforms, even, right?
Right. Yeah. No. Schwab has like 3 or 4 different platforms.
Yeah.
So by the way, the reason I keep Schwab is for the Thinkorswim platform that they got with the TD Ameritrade acquisition. I have it up right now, and I can watch 100 stocks at the same time with one little glance in my head. I love it. I see a few more SoFi questions. Tim Noteboom says, SoFi update specifically, how has resumption of student loan repayment impacted their revenue and earnings? So SoFi's student loan business. It started life as a student loan a private student lender. That's what it originated as. That's kind of taken a backseat to personal lending, especially in the post-pandemic years when, if there was like a 3-year period where no one had to pay their student loans, and so nobody was refinancing because that's their bread and butter. It's not necessarily student loan origination, even though they do offer that. It's student loan refinancing is what Sofi really offers. And that business was thriving back when they could offer student loan refinancing at like 3 or 4% interest. That's not the case anymore. So I think I have student loans. My student loans are at, I think, an average interest rate of like 6.25%. If SoFi's offering me 8%, why would I refinance that? Especially and lose all the federal student loan benefits. But if SoFi offered me 3% interest on it, it might be worth it. So I think SoFi's student loan, first of all, a lot of people aren't paying their student loans yet. The SAVE plan, while it was in limbo, anyone who had applied for it didn't have to make their student loan payments. No interest was accruing, things like that. And I mean, the letter I got says you won't have to make any student loan payments or pay any interest till a minimum of 60 days after that whole situation's finalized. So a lot of people aren't paying their student loans yet. It's worth noting. But the real key is going to be the refinancing business. When people have reason to refinance their student loans, specifically meaning that interest rates are going down, that's when that's going to come more into play. They are a private student lender, but refinancing is really their bread and butter. There's well over $1 trillion of federal student loan debt still, even after all that was forgiven over the past few years. So there's a big opportunity, but no one's going to refinance when interest rates are worse, when you have to give up all your federal student loan benefits to use them. So that's what I don't really expect that to be a big growth area of their business until interest rates come down.
Do you know, Matt, are student loans still capped at
Yes.
a certain interest rate? So it might even.
Yeah, and I don't even think it was ever indexed. It wasn't indexed for inflation, so it's the same caps that were in place when I was in school.
So we may be in that universe where it's not just when interest rates come down; they actually need to come down a decent amount to get to the point where you'd start to see some refinance motivation, right?
Yeah, and
although I guess you may always have the consolidation, desire for some of these loans, right? So there's
and I mean, the great thing about the student loan business is that default rates are minuscule. Student loans, even private student loans, are the one type of debt you can't discharge in bankruptcy, so people pay them. People, you can't. It's not like a credit card where if you're in terrible financial circumstances, you can stop paying it and then just declare bankruptcy and it goes away. That's not the case for student loans. So default rates are very, very low, which is why SoFi was able to offer student loan refinancing at like a 3%, 4% interest rate for a long time. So if interest rates start to come down, they're going to be able to offer competitive rates again.
Yeah.
I've said before, like, I don't think mortgage rates are going to be in like the 3% range in my lifetime. I just don't. I could be wrong, but with student loans, I do think SoFi is going to price those aggressively once interest rates start to fall, just because the default rates are, they're like under 1% on SoFi's portfolio of student loans. So I think they will get aggressive with that business when the time is right. Let's see. See a lot of long lists of questions. I had a few older questions picked out that I can answer as well, but they're not really. Ooh, here I do see a good one on buybacks and stock-based comp, because I'm apparently the stock-based comp police. It's down a little ways in the queue, but it was from Matt. It's from 4 hours ago. It says, I thought that most companies are buying back shares these days to try to pretend like they're negating the dilution from stock-based compensation. There are definitely companies doing that. One of my favorite stocks is XYZ or Block, Square, whatever you want to call it these days. They have a pretty decent sized buyback plan, but they make it very clear that it's to offset dilution from stock-based comp. It was like $1 billion plan, and that's essentially what they're spending each year in stock-based compensation. But there are also a lot of companies that are buying back shares for the right reasons. PayPal, I already mentioned. There are a bunch of others right now that just really honestly feel that their shares are undervalued and that buybacks are the best way to deploy capital. I mean, for PayPal to literally be spending 100% of free cash flow and their share count is going down rapidly. Um, that's one that's not just to offset. I mean, they have some stock-based comp, but that's not why they're doing it. Outside of the fintech realm, there's companies like General Motors that are just buying back stock hand over fist right now. Even one of my favorite kind of micro cap companies is a company called Nextdoor. You know, the other social media company that's about neighborhoods and things like that. A lot of people don't even realize they're public. The ticker symbol is KIND, KIND. They've been buying back stock pretty aggressively to take advantage of a big dip in their stock price. But there are a lot that are not just trying to offset stock-based comp, that are actually, buying back for the right reasons. It's sometimes tough to discern which is which. Um, and one of my biggest pet peeves is too high stock-based compensation. As everybody knows, I think it really, if it's high enough to the point where it really distorts earnings and makes an unprofitable company look profitable, I'm not a fan of stock-based comp. But yeah, so that's kind of my thoughts on buybacks. There are a lot of companies doing it for the right reasons right now.
Mm-hmm. Yeah. There's a question here from Jimbo a few minutes ago. What do you make of the Grab report? Jimbo, I like it. I think it was good, right? I think from a business standpoint, this was a solid report. Revenue was up nicely. Gross merchandise volume rose 20% on their platform. They're profitable for the quarter. Things are moving in the right direction. Guidance was maybe on revenue next year was maybe a little bit soft from what people were expecting, and I think that's one of the reasons you saw the sell off. Now, look, I think we also need to point out that Grab has recently caught the attention of some influential accounts on Twitter. There's a lot of conversation going on about them very, very recently, and that if you look at the stock price, you saw kind of a run up in the past couple of days, past week ahead of earnings. I think there was some thought among some circles that maybe Grab was going to be the next Palantir in terms of like the stock to get in to get rich quick, the next meme stock, and the earnings report didn't necessarily support that level of optimism. And you saw a sell off because you had seen a run up, I think, which is, I don't think, really related to the business itself. But the business looks good to me. They're moving in the right direction. They're doing what you want them to do. So if you can take out the short-term stock price movements, which I'm not going to blame management for what people on X are talking about, right, and what the stock price might be doing as a result of that. I think it looks fine, all things considered, and I think you're getting a better price now than you were, a couple weeks ago because of maybe some external excitement about now. We do want to see excitement, Matt, right, in the companies we own, because if you don't see increased demand for your shares, it's never going to go anywhere, especially like a company like Grab, which doesn't have a lot of name recognition in the United States, right, is in Southeast Asia. It's just not part of the day-to-day reality of most U.S. investors. So it's good to see people starting to pay attention to it and starting to catch on to what they're doing. But that does come with some downsides, which can be higher fluctuations in the stock price in the short term. So you take the good with the bad. And if you're a long-term holder, I think you like what you're seeing, both in the business and that people are starting to pay more attention to it. And you recognize that you have to kind of, invest opportunistically if you're looking to build a position and commit to holding for the long term for this business, I think.
All right. Vihan has a list of a bunch of real estate stocks. I'll just read it real quick. I'm going to give kind of an answer that might disappoint you a little bit. The tickers are Prologis PLD, Ryman Hospitality Properties RHP, Net Lease Office Properties NLOP, Extra Space Storage EXR, East Group Properties EGP, Vici Properties VICI. He asks your gold, silver, and bronze. I believe that's what GSB means. Valuation metrics. So my short answer is ask me tomorrow. And the reason I say that is because Ryman and Vici both report today after the close. It's a non-answer, but for a reason. But as far as some of those on the list, like Prologis is one of my favorites that I've written about. I've written that it's one of my favorite stocks to buy in 2025. They're a massive they're the biggest real estate company in the world. They're beaten down because of oversupply concerns in the industrial space, um, rent pressure, things like that. That they're really starting to turn a corner. It's not at an alarming level at all, but they're really starting to turn a corner. And as interest rates fall, that could be a big winner. They're quietly getting into the data center business, which I really love. They're well capitalized. They have access to amazingly cheap borrowing. This last quarter, they were able to issue, I think, $1.5 billion of debt at 3.5%. I can't borrow at 3.5%. They have, most companies can't. They have tremendous access to capital just because of their scale, size, balance sheet strengths. So if I would have to name a gold out of those, just off the top of my head, it would probably be Prologis. Extra space storage I liked better before the merger with Life Storage. I liked Life Storage. That was my favorite operator in the space. But having said that, I do like that they have a third-party management business, meaning that they're using their brand on properties that they don't own and managing them on a third-party basis. I think it's a nice capital light way to increase income for a real estate company. But yeah, for Ryman and Vici, stay tuned for after the close.
All right, Matt, I'm going back to the beginning of the hour here. I'm going back to 53 minutes ago from a question from Mark H, who asked, if you had to buy one of these stocks, Axon, Palantir, or the Trade Desk, which one would it be? I like this question. All three of these has seen the decline recently, right, for various reasons. Only one related to earnings that I can tell. So if I'm picking between those three, say you gotta give me just one of these three, which one are you buying? My answer is not Palantir. Quite honestly, I think it was overvalued before the drop we've seen, and I think it still is. That's my personal opinion. Others may differ. I saw something on social media, Matt, where someone was saying, "Oh, you're getting a good deal now if you buy Palantir at 100 times sales." I'm not sure if that was sarcastic or not, but I mean, wow. I do not think that. Oh, we'll leave it at that. Between the other two, so I would go with the Trade Desk right now for this reason, because Axon has not reported earnings yet. They do that on the 25th, so next week. Axon's drop was related to the end of their partnership with Flock, maker. That their big claim to fame was the security license plate readers, right? Then they've got more going on now. They're more of a direct competitor. That partnership has kind of fallen apart. That's why we saw Axon, along with the downgrade that was also directly related to that. That's why we saw Axon down recently. The Trade Desk fell on earnings, right? And so if you said you had to pick one of those right now today, I'd say the Trade Desk, because I have that information. I've looked at that report, and I'm a big believer in that business going forward. I think they're going to do well. I'm comfortable buying those shares, given everything I know. Axon, I like too. I think it's a great business. I think they're going to continue to do well and succeed. But I would wait until the earnings report and to see how they address this Flock partnership in that, and what the number, also what the numbers are. Right, it's less than a week away. Because of the higher valuation of Axon, it is a premium valuation, at least before the drop. I think it still is to some extent. I become more conservative around earnings with companies with premium valuations, and that's why I would say I would not buy that ahead of earnings. But my answer to the question of Axon versus Trade Desk could be different next week, depending on what the report looks like and depending on what they say about the Flock partnership and how they plan to address that going forward. So hey, maybe come ask me again what I think next week after earnings, and we'll sort through that. But there you go. That's my answer. You got any thoughts on those three, Matt?
I mean, not really. You can make the case either way. I'd say the Trade Desk just because it's a business I understand better, and that's really important to me.
Yeah.
I could go either way on that though. I will say, and on the Trade Desk, and since this is a fintech's earnings theme show, one of my favorite things about earnings season is when a company will miss growth expectations by it'll be like 1 or 2 percentage points less of a growth rate than was expected, and then the stock will fall 20%. Those are some of my favorite situations, and where half of the investments in my portfolio came from because of market overreactions to events, especially additions to existing positions. I love when that happens, when it's nothing that busts the thesis, which I think you could agree, the trade desk's report, there was nothing that I thought was like thesis busting in it. Just not the numbers weren't as great as everyone wanted. Um, or when guidance is for like a percentage point or two lower than expected in revenue growth or something like that, and then the stock just completely overreacts. You'll know what I'm buying in the next week or two, based on when when that happens with some of these stocks I really like. But yeah, I can't really pick a winner out of those. Um, I do see a few questions on stocks that are beaten down that I do love that I haven't reported yet. Um, Redfin's one of those. I don't know, Toby, do you follow Redfin at all?
I do. When's their report coming out?
Next
Do we
week.
know?
I'm not sure the exact date, but it is next week.
Next week's shaping up to be a good week too, Matt.
Yeah, that's like the fun
Got a
week
lot
of
going
earnings.
on.
It's all like the smaller kind of like
Yeah.
the exciting companies.
Yeah.
But Vihan asked about Redfin right there. It's his current thoughts on Redfin valuation. It's the thesis on track. We did actually get a preview of news for Redfin because Zillow reported earnings last week and announced a partnership with Redfin. Essentially, Redfin is no longer going to be providing its own multifamily listings on its rental platforms. Zillow is going to be providing them, and presumably paying Redfin a referral fee as traffic comes to its platforms and things like that. Redfin, one of my favorite moves they made. I think they overpaid a bit, but they acquired a company called RentPath out of bankruptcy a few years ago. And that brought Rent.com and ApartmentGuide.com. You remember those apartment like books that used to be everywhere? Redfin owns that now. So it's a really great rental platform, but Zillow is going to be providing all of the actual properties. So it's a really capital light way to grow their revenue stream. And Redfin needs capital light ways to grow their revenue stream and become profitable. My current thoughts on Redfin is they're making the best of a bad market. And the sooner the market turns around, the better. But if it doesn't happen, hopefully that they'll continue to make moves like that to be able to exist even in the bad times and without hemorrhaging money. But I think Glenn Kelman's doing a good job in a terrible real estate market.
Yeah. I want to hit R2D2's question real quick here from 5 minutes ago. He says, Grab is a blank check company like Skills is. I thought TMF doesn't buy those. Why do you think small tiny position in Grab is safe? Blank check meaning SPAC. Well, I mean, I wouldn't call them that now, right? Because this is post SPAC merger, right? The idea here, for those who are not familiar, right? You have this idea of you can start a company that it really has no business. It's capitalized, and the goal is to go out and do an acquisition, generally of a private company, though you don't necessarily have to do it that way. But generally of a private company. This is an easy, cheaper way for some private companies to come public. There was the heyday of this right after COVID, right? It seems like everybody was doing this. There is no TMF restriction or dislike of that in general that I'm aware of. And we did have many recommendations of companies that came public by us back.
Sofi is one of them, actually.
Sofi is doing very, very well, right? I don't think it's not the case that you can make a blanket statement that every company that comes public via SPAC is necessarily bad, right? Or that every company that comes public via traditional IPO is good. We see some flameouts there too. My general approach to newly public companies, whether it's through a traditional IPO route, whether it's through a SPAC merger, I tend to not want to buy them right away. That's just how I approach things. I tend to like to let them sit for a while and get a couple quarters, maybe a full year of financials, get me that first audited annual report as a public company before I proceed. Now, there are exceptions depending on who the company is, but that's my general approach. And so if you're doing that, the potential negatives of SPACs are less a concern, I think, because you're waiting to see how it turns out, right? And for me, Grab actually is a recommendation at Stock Advisor. We believe in the business. The business has been doing well, I think, recently. And I don't hold the route to which they came to the public markets against them now, right? They are a business. They're doing their thing, like Sofi, which also came out that way. And yeah, we do think it's we think it's a good business. We like what we see. I think it's still I want to say around 20 billion market cap. I think I'm not 100% sure on that. But it's a sizable business with real revenue, I mean, they got a lot going on. Like, it's a real business. So just because they came public by SPAC is not something I hold against them at this point.
Yeah, I think by this point, I think all the bad SPACs have kind of worked their way out of the market,
Washed
or,
out, right?
or at least are apparent that they were bad companies.
Yeah.
You know, like there are a few that are still hanging around that I unfortunately invested in, like 23andMe is one of them. You know, great product, but a terrible business.
Yeah.
You know, that's still hanging around after a couple of reverse splits, I think. There are a couple that are still hanging around, but there are also some really good ones. You mentioned Grab, SoFi, DraftKings was arguably the one that originated the SPAC boom because it was so successful and is still very successful. There are some really good ones. I wish I had followed the advice that you just said and had let some of these SPACs marinate before I invested in them. Because you know, if I would have waited a year, you would have been able to separate the good from the bad a lot better. You know, and the problem with that big SPAC boom is a lot of companies were taken public too early.
Yeah, right. And you know, it depends too. Like if a company like Reddit how did Reddit come public? They just did an IPO, right?
Yeah, they
And
did an IPO.
If they had come public by SPAC, I'd be less concerned because this is the business that's been around for a very long time.
Right. But a lot of businesses were just, and when you had at one point, I think there were 400 or so outstanding SPACs that each had like hundreds of millions of dollars to take companies public. When you have that many different pools of capital looking for a target,
there's going to be, you
had to kind of go down the list.
Right.
Yeah,
like
not every company. Yeah, not every company taken public could have been a grab. Or
the motivation to do a deal at all costs can be problematic.
Right.
Both in the public and private markets. All right. Unfortunately, fools, I still see some good questions. I think Matt and I would both love to hit, but we're up at time now, so we're going to have to defer those. We got to make sure we do another show again soon together, Matt, because we seem to get good questions.
Of course, you seem to like this 3 o'clock hour, and so do I. So
I like that. Yeah, this is a good time. Thank you, Matt. This was fun. Thanks for coming on. Glad I could be on with you. Good time here. With that, though, we're going to turn you guys over to Rachel and Danny, who are
this
going
is deja vu.
Yeah,
I know. We're back.
Speaking of earnings, you guys have Danny and Rachel for your market close hour. So hey, let's see what the excitement we get from reporting companies in the next hour here, huh?
I know Danny's going to have one eye on MercadoLibre.
That's definitely the case.
All right, take care, guys.
Thanks, guys. All right, fools. Welcome to another hour of Fool24. Danny and I are back in the hosting chairs for this hour. Danny, how's it going?
It is going well. I am eagerly awaiting, as Matt said, the release of MercadoLibre's financial results.
We are definitely watching a bunch of companies, including MercadoLibre. And fools, if you have any questions about companies that are reporting earnings or have or are about to, we will do our best to answer those. You know, for today's theme, we're talking about pick and shovel plays. And, you know, what does this mean? This is such an interesting term that essentially you're talking about companies that provide essential tools, equipment, services, products, one, to a rapidly growing industry, but essentially profiting off of supplying the picks and shovels that are needed to participate in that industry rather than directly competing, you know, with the main activity itself. So you could think about, for example, you know, in the current AI boom and the current AI landscape, companies like NVIDIA, which manufacture the GPUs that are used in AI computing, they could be considered a pick and shovel stock as they benefit from, you know, widespread adoption of this technology. That's just one of many examples. And sometimes pick and shovel stocks can offer a bit more stability compared to companies that are perhaps pure plays on whatever the theme or trend is that you're seeking to invest in. The fun thing for me is this term kind of goes back to the story of the California gold rush, where the sellers of picks and shovels historically made more money than the actual gold prospectors. That's always been a fun fact. But I'm curious to hear your thoughts on this, Danny, as well. You know, there's so many different ways to approach this type of a theme in one's investing journey. How do you tend to approach this with your own personal investment portfolio?
Well, first, I wanted to start off with, sharing the quote And actually it was attributed to Mark Twain, who said during the gold rush, it's a good time to be in the picks and shovels business. And like you said, picks and shovels, you've got the folks who are out there panning for gold, and not too many people made money panning for gold. There were a few people who struck it rich. But the people who were selling the picks and shovels, they made out like bandits.
Yeah, definitely. And that's so cool. The story where with Mark Twain, there's so many kind of different companies I think of when I think of this approach to investing. One that I actually I can start off with and then kick it back over to you, Danny, that just reported earnings that I know is kind of widely followed by some investors is Vimeo, right? So they're a video hosting platform. They provide tools for video creation, editing, and broadcasting. And we live in a day and age, especially with the continued popularity of social media tools and online platforms, where video creation and content creation is the name of the game. And what Vimeo does is they offer paid plans for businesses, for content creators, including storage, customization, and marketing tools to help create these videos. They offer an OTT platform, an over-the-top platform that allows users to stream video content, to monetize their videos, and manage their content library. So you can look at how this is a company, for example, that is capitalizing on the growth of the content creator industry, that is capitalizing on the growth of video content as a means of advertising for businesses across a range of sectors. And they are providing the tools and software that is needed to create that end result, to create that final piece of content. And this has been an interesting business to follow. The stock itself has been volatile, and I think they have been working to make some financial improvements on key metrics. But it's worth noting that they serve a wide variety of global brands, including grocery stores, big box retailers, healthcare and life sciences companies, insurance companies, media companies. They help serve video content in over 190 countries, including China. 45% of their revenue comes from outside the US. So again, all of these different industries that I named that are these core clients for Vimeo, they all have a need for quality video content for advertising and other initiatives. And Vimeo is one of those businesses that provides those core tools. They, in 2024, they grew their enterprise bookings from customers that deliver 100,000 or more in annual recurring revenue. That cohort of customers grew by over 50%. They also delivered 78% gross margin last year, net earnings of about 27 million, and their adjusted EBITDA reached an all-time high. And, they're still working to grow, revenue. There's been some kind of poor year-over-year comparisons the last few years. So they did report total revenue in the final quarter of the year of about 103 million. That was down slightly year over year, but still a solid figure. They generated cash from operations of about 11 million. And as I mentioned, net earnings of about 2 million. So this is just one example of a business that I think when you're thinking of ways to do pick and shovels plays, this might be a lesser thought of way to approach that. And this is a company that kind of stuck out to me as just one of many examples. And I wanted to pick a company that wasn't just healthcare because I talk about healthcare so much. So that's one that came to mind right off the bat. But I'll kick it back over to you, Danny.
So we were just talking about MercadoLibre, ticker MELI. And I looked in after hours trading, the stock is up about 12% after hours. So I expect the results are probably good. I looked on the website and they're not on the website yet, but I did see where the shareholder letter hit the SEC's, the Security and Exchange Commission website. And so the short version is that revenue was 6.1 billion, up 37% year over year, or 96% in foreign currency exchange neutral dollars, and in essence in local currencies. Income from operations about 820 million, 13.5% margin. This looks pretty good. They announced that their gross merchandise volumes passed 50 billion for the first time last year. So it looks like, just without seeing all of the numbers, it looks like Wall Street is liking what they see.
Yeah, those are pretty fantastic figures. That's a business that I followed a little bit. I know you know it, much better than I do, and I know you've been a long-term shareholder of the business. Nothing really, seems to stick out in terms of any glaring red flags from that report.
No, and actually, I'm going to go ahead and pull the shareholder letter and the earnings presentation up on their website now that they've hit, and take a look and see what the numbers tell us. And I'll be looking at that here in the next couple of minutes.
Sure. Maybe in the meantime, there were some questions that came in. One was from Therapist Fool, who was saying, Rachel, do you see Twist as a pick and shovels play in genetics? What would you look for to know that they are headed in the right direction? That's a great question. I do think that I would look at a company like Twist as a pick and shovels play within the genetic space. So for anyone that doesn't know this business, they're a biotech company. They specifically are known for their synthetic DNA and DNA products. And essentially, they use what is known as a silicone-based platform to write DNA on a chip. And they're able to produce this synthetic DNA at a lower cost and also in a much more customizable way. So there are use cases for this, obviously within genome editing, but also helping to develop libraries for drug discovery and development. These can also be really integral tools just for the broader medical research community. So, for example, the silicone-based platform, which allows the company to synthesize custom DNA at scale for a client, which could be, say, a biotech or a medical research firm or a pharmaceutical company. By using this platform that helps to create customized synthetic DNA, researchers can design and order specific DNA sequences online. And because of the process that they use, they are able to enable the creation of large quantities of synthetic DNA at scale with very high precision and turnaround times. And though that synthetic DNA, which has been customized by the client for use in medical research, is then used in things like drug discovery, diagnostics, genetic engineering is another example. So drug discovery is a big application here. Next generation sequencing panels, which are an increasingly important aspect of the diagnostic space, is another area. And then again, for gene editing. So for example, let's say you're a company that's making or developing a CRISPR therapy. This is a situation where the client could order these custom DNA samples, which the company Twist would produce, and then they can use that as they're generating specific gene sequences for a CRISPR therapy. So there's a lot of potential for a business like this. A lot of the companies that work with Twist are involved in drug discovery and genetic testing. There's also some potential applications outside of humans, for example, in agricultural research, where you could foresee a situation where scientists are designing and synthesizing genes that would help improve crop traits, like, for example, helping to engineer crops to be more resistant to pests that would impact crop yield in a given season. So there's a lot of, I think, things that I find really interesting about this business. From a financial perspective, I think that would be the biggest thing I'd be looking at to see, how are they doing? Are they headed in the right direction? I wanted to go ahead and pull up their most recent report, and I am not sure if they have yet reported their full year report. It looks like they actually reported for fiscal 2024 late last year. And so they already are well underway into fiscal 2025. So they delivered orders of about 344.2 million for their for their genetics sequencing DNA chips. They also delivered revenue of about $313 million, and they delivered a gross margin of about 43%. So they are working with different companies, like I mentioned, across these different applications, including healthcare companies, agricultural clients. There are a lot of different disease indications that their synthetic DNA chips could be used for. They have a combined biopharma business that they report under that currently has several hundred partners that they're working with. So I think what you're seeing is there is very much a need for their platform and for their products. And there's a diverse range of clients that can benefit from what they're producing. The biggest thing I'm looking at right now is for them to be improving their net losses and also to see how they are delivering growth in their various segments. Biopharma is a big business for them, but there are other areas in which they're trying to grow their potential range of clients for these different synthetic DNA offerings that they provide. So I would be looking for more robust financial growth from this business before I would consider a position. I don't think this is a company that is close to profitability. If anything, I would probably take a very small position in this in my personal portfolio right now. But I think this is a great example of a company that is absolutely in pick and shovels play on so many different aspects of the healthcare space. And again, their platform, manufactures synthetic DNA by writing DNA on a silicone chip. This is a very early stage in its growth story kind of a business. So I think that there is a lot of risk that's inherent to that one needs to consider alongside, overall financial goals and portfolio goals. But I think there's a lot of promise for this company. I would probably be watching their partnerships